start with the first section. So I invite here the chair, Paolo Pagnottoni from the Università degli Studi dell'Insubria. I leave the floor to Paolo, that managed the time perfectly.
I hope so. I hope so. Thank you very much. This is a very interesting session. We will present the session on designing trust, governance, validation, and failure models in digital money. So I invite the first speaker, which is Maarten van Oort, with presenting buyback programs for platform tokens. Okay, please. You have 15 minutes, let's say, and then we will lead to the discussion 5 minutes. Okay, so try to stay. Thank you.
Oh, good morning, everybody. Great you made it after the fantastic dinner yesterday. Really enjoyed. I hope you did too, and it's great to see you here at 9 a.m. this morning. It's a great pleasure to present this paper. It's always a great pleasure to attend the Crypto Asset Lab conferences. I think it's already like the 6th edition, so it's quite great for a field that's been there for a very short time. So the paper that I would like to present is buyback programs for platform tokens. And basically what we observe, this one doesn't work, is that buybacks are becoming more and more common. Initially they were pioneered by crypto exchanges, and now we see like a lot of DeFi platforms that start to implement buyback programs, or basically even higher. Where DeFi platforms are increasingly buying back or implementing buyback programs. So what I would like to do in this talk is I want to talk very shortly about buyback programs in practice. We only have 15 minutes. And I would like to talk about the main focus of this presentation is actually how do you value, how do you do the valuation for tokens where you have a buyback program. And then I also want to quickly touch upon whether there are any downsides to buyback pledges. So buyback tokens or buyback programs in practice, well, one of the infamous cases is the FTT token that was issued by the now defunct FTX exchange. So basically when they when they issued their token, it was called the FTT token, basically there were like a few things in their white paper that you should notice. So first of all, they promised that they were going to use certain resources, 1/3 of the revenue that they were generating, to buy back tokens. They also promised that they were going to buy back, they were going to continue these buybacks until they would have burned half of their tokens. So very clear target, very clear pledged resources, 1/3 of the fees. And then there were some nice things about having these type of tokens. So if you were having a certain dollar amount of these tokens in your account with FTX, you would actually get a discount. So they actually had this nice schedule. So for example, if you had $1 million of these FTT tokens in your FTX account, you would get a 40% discount on the exchange fees. So giving you good incentives to hold these tokens. Of course, we also know that the FTX collapsed. So kind of when FTX collapsed, they were no longer going to honor the buyback pledge. So the price, and there were no further discounts in the future. So you saw that the price collapsed to, well, less than $1. Another example, Binance, the BNB tokens, they were one of the first to issue a token with a buyback pledge. Similarly, very similar structure. So basically they said like, well, if you have these tokens, you're going to get discounts. So this was the initial schedule. Basically now you always get 25% discount. And the discount actually didn't depend on how much of the tokens you had in your account, but basically on whether you were using these tokens to pay for your fees. So if you use BNB tokens to pay for your fees in the exchange, you're getting a 25% discount on the exchange, on the fees. Similarly, they have a very explicit pledge. 20% of their profits they are spending on buying back these tokens. And they will continue to do so until they have bought back 50%. And you can track this live. It's kind of nice. You have this website, bnbburn.info. You can basically look like how much did they burn until today. And you see like they're well on their way to burning 50%. If you look at many of these type of exchange tokens that have these buying back pledges, they basically share these properties. So there's an incentive to hold them as a user, either because you get a discount if you pay for fees or if you hold a certain dollar amount of these tokens. There's a certain buyback target, so they've pledged that they are going to buy back a certain number of tokens. And there are certain resources pledged. So, for example, 20% of the profits, 1/3 of the transaction fees. So how do we determine the value of a token like this? And you can kind of see why this is a tricky thing. Because if the price is going to be very expensive, then it's going to take a very long time to buy back the tokens that you promise to buy back. So for example, 50%. If the price is very low, then it's going to take a very short time to buy them back, because with a certain amount of resources, like of the price very low, buying back tokens goes much faster. So if you want to solve like what's the current value of the token, you both have to determine how long it's going to take and what's going to be the current price. So you have to do this simultaneously at the same time. So pricing platform tokens. So basically what we're going to do is we have a model and we're trying to capture the most salient features. So there's going to be user demand and there's going to be investment demand. So there are going to be investors in the model. There are these buyback pledges that very much follow the structure that we have seen. But then we also introduce default risk to capture cases like, for example, FTX. If we move to the model notation, basically time is continuous. There's a certain number of tokens issued. Think about the M for money. And there's an exchange rate. So the exchange rate is going to be endogenous. We want to know the exchange rate, so we got to solve for the exchange rate. This is why it's light blue. And there's going to be investor demand. Investors in our model are as simple as possible. They just want to make a return, a required return R. And they only care about that expected return. They're not risk averse or anything. Just a very simple kind of rate at which they want to invest. There's going to be a number of tokens that's going to be held by investors, and that's also going to be endogenous. So Z is going to be the number of tokens that's held by investors. They cannot hold in the aggregate a negative amount. Of course, individual investors, they can take a short position, and another investor can take a leveraged position or a long position. But in the aggregate, they cannot take a short position. Why is that the case? Well, if investors in the aggregate take a short position, it would be equivalent to creating more tokens. That's not possible physically, at least that's what we're assuming. So the number of tokens that's held by investors must be strictly, or must be positive. Then there's going to be user demand. So there's going to be activity on the platform. We denote that by capital A for activity. And there's going to be user demand for tokens. So it starts with a certain value. For example, $1 billion demand for BNB tokens because people want to use them to pay for fees. But if the activity on the platform grows, if A is increasing, then basically the user demand we are going to assume is going to increase along with A. There's also going to be a buyback pledge. So we're going to capture a buyback pledge. So basically the number of tokens that the platform promises to buy back. It is U. So this is a certain number. And basically what we will be showing as well is like, well, we can actually also capture indefinite buybacks. If you set the U equal to the M, basically promising to buy back all the tokens is equivalent to having an indefinite buyback program. How are they going to buy back? Well, it's based on with resources. So basically there's a stream of resources that the platform pledges. For example, a share in profit, a share in the transaction fees. And they pledge this to use to buy back the tokens at the current market price in order to withdraw them from circulation. So the number of tokens that's burned by the platform is basically denoted by W, which depends on 2 moments in time when they start the buyback program until some time T. Right? This W, you can actually calculate it. So how can you calculate it? Well, if you look at all the resources that they spent over time, so for example, $100 million this quarter, $100 million the next quarter, and basically if you know the exchange rate at that time, you can basically calculate like how many tokens did they buy back. So the total number of tokens that they buy back is basically the resources that have been spent over time divided by the exchange rate at which the exchange bought back the tokens. Of course, then if you have continuous time, it looks like an integral. And then I promised that we would also capture platform collapses. So how do we capture a platform collapse? Well, basically, we have a Poisson process with the intensity lambda. If that process materializes, basically then we're going to have a default. So the activity on the platform drops to 0. And otherwise, we're going to assume a very simple structure is that there's just going to be exponential growth with the parameter g to capture growth. Like we're going to look at a very simple valuation model just to capture the basics. And in the model, you must always have market clearing. So the token supply must always equal the token demand. What's the token supply? Well, these are the tokens that were issued minus the ones that were burned. The token demand is, well, the dollar demand by users divided by the current exchange rate plus whatever is demanded by the investors. Yeah? So if you look at this in a chart, basically it looks like this. So here there's M tokens. This gray area is basically the user demand in dollars. And here we have on the horizontal axis the number of tokens that were burned by the platform or that are held by the investors. And if they start to burn more tokens or more tokens are held by investors, basically you're moving up this curve. You can have the same user demand in dollars against a higher exchange rate. Because now basically the users, they're willing to hold them at a very high price just to satisfy their user demand. Then what's an equilibrium? Equilibrium is a path for the exchange rate, the number of tokens that are held by investors and the number of tokens that have been burned over time. Where the market clearing condition holds, investors, they must have no incentive to deviate from the path. They are making the required return, and then we need some technical no-bubble condition, otherwise you can have any positive price path that exceeds the baseline path. And what's kind of interesting in this model? Well, basically, if you look at this model, there's basically 2 types of solutions, 2 types of regimes that you can have. One is a utility regime. And basically, in the utility regime, investors, they do not hold the tokens. So basically, the expected rate of appreciation, it depends on the growth in the activity. And it depends on the ratio between the resources that are pledged by the platform per period, divided by the user demand. So these both, the growth in the activity as well as the burning of tokens, that increases the exchange rate at the rate of G plus this ratio. Of course, the platform can also collapse. So the expected rate of appreciation you need to correct for the default risk. If this growth rate is less than the cost of capital for the investors at which they are willing to invest for the required return, then the investors, they do not want to hold the tokens. So basically the exchange rate is going to look like this. Basically, over time, if there's no collapse, the tokens are going to appreciate at the rate G plus the ratio between the buyback resources divided by the user demand. You can also calculate the time until how long does it take for the platform to buy back the tokens. If they pledge more resources, then Y is going to increase, then it's going to take shorter to finish the buyback pledge. They promise to buy back more tokens if U is increasing. You see that this denominator is increasing, so the time it takes to finish the buyback pledge is increasing. If U is equal to 0, if they don't promise to buy back any tokens, D is 0, right? It's going to take no time. There's also a second regime, which is the investment regime. So in the investment regime, investors, they hold tokens. So investors, they want to hold tokens if the pledged resources are sufficient so that you're basically at the expected rate of appreciation, if there were no investors, would be larger than the required return. Basically, then what happens is that the investors, they step into the market and they start buying the tokens. Also then you can calculate what the exchange rate is. We also get a closed form solution for the time to buy back, and it's all very intuitive in terms of like, well, if the Y increases, it's going to take shorter. If you promise to buy back more tokens, it's going to take longer, etc. What's a kind of a cool thing? So there we see many buybacks nowadays where basically the platform just pledges to use resources to buy back tokens. So these are kind of indefinite programs. If you have a program like this, basically, then you are in a situation where, if you're in a situation where the platform never finishes the buyback program, it just continues forever, then basically what you have in the investment regime, so if the buyback is sufficiently aggressive, then basically the valuation model, or the valuation of the tokens becomes equivalent to this number. So the value of the tokens is going to be 1 divided by m. M is the number of tokens, times y. Well, y is basically the amount of resources you're spending on the tokens, divided by r plus lambda. So that's kind of that's the required return plus the default risk, minus g, which is the growth rate. Now, if you're looking at Finance 101, you know this formula, or a formula that's very similar, which is basically the Gordon growth model. Yeah? So basically what you see in the limit, if you have an indefinite buyback program, if the buyback program is sufficiently aggressive, then the valuation is just equivalent to the valuation of shares in a company in a Gordon growth model. Yeah? So I wanted to show this result, so let me quickly move to the conclusion. There are also disadvantages of buybacks. One of them is kind of being like, well, suppose you promise to buy back 90% of the tokens, but you have one large investor who owns 20% of the tokens who doesn't want to buy back. And basically the investor can take advantage of the platform. For that you have to read the paper. So basically, to summarize, we have a tractable model for exchange rates for platform tokens that incorporate commonly observed buyback pledges. We get closed form solutions for prices of the platform tokens and the time to finish the buyback. And the valuation of indefinite buybacks is similar to the price of stocks in a Gordon growth model. For the rest, please take a look at the paper. We also talk about some regulatory implications in the paper. For example, like the extent to which tokens would fall under potential security regulation in the US. Thank you.
Thank you so much. Thank you for staying on time. I invite the discussant, Marco Bernardo, and in the meantime, if there is some quick question from the audience.
Have you tried to calibrate?
Do any empirical work? So far we haven't done any empirical work, but some of the numbers that you kind of read in the tables for the exchange rate tokens, you could use them immediately to calibrate the model. For example, the U, the M, these are parameters that you can observe. The Y you can observe immediately. The required return, of course, and the growth rate, these are a little bit more tricky. And the default risk, yes.
Thank you. So I leave the floor to the discussant.
So thank you very much. I will start by apologizing for two reasons. The first reason is that I'm not an economic and finance scholar. I'm a theoretical computer scientist. And in my community, there is no such a role of a paper discussant because conferences undergo very strong review process similar to that of journals, okay? And so the other reason why I apologize is that not being economy and finance scholars, I will not be able to provide very useful comments. Anyway, it was a very pleasant reading in my trip to Milan, and this is a sign that the paper is very well written. I mean, when someone which is not from your area understands most of the paper, it is a good sign to me. Okay, so I have only a couple of specific comments. The first one is about the 4 research questions that are in the introduction. So how do buyback pledges affect token prices? This is the first one. The second one is how long does it take for the platform to repurchase a target share of tokens? The third one is why do buyback pledges exist? And the fourth one is what are the regulatory implications? I'm not sure whether this is the right order of these four questions, in the sense that the first two are the most interesting ones, for sure. But from a foundational viewpoint, the last two maybe should come first. I mean, just think about this, okay? And I would not mention the two phrases utility regime and investment regime inside the first question. Those two phrases, in my opinion, should be moved before, okay? And the other comments that I have is a bit more technical, on the technical side. I saw along the paper a number of exponential functions without any motivation. Maybe it is standard in your community. Given that time is continuous, the only hypothesis I came up with is that there is under the hood a stochastic process which is a continuous time Markov chain, or something like that. Is that correct, or my hypothesis, or not necessarily? Please use the microphone. For people connected from.
Yeah, there is an underlying stochastic process, but the stochastic process is just on the A parameter. So it's kind of, yes, it's kind of growing at rate g over time, and then because this continuous growth rate, continuous time growth rate, you automatically get the exponential function, and then the process says, well, it drops to 0 if the Poisson process materializes.
I would suggest to explain in more detail why it has that shape, just this. Thank you. Thanks a lot.
Good, thank you very much. If there are no other remarks, we go on with the schedule. Okay, so I call on the floor Marco Bernardo, again, and he's presenting on the operational resilience of CBDC, threats and prospects of formal validation for offline payments. Please, the floor is yours, 50 minutes.
Okay, thank you very much. So this work is about a proposal of using formal methods in computer science for ensuring the operational resilience of CBDC. This is a joint work with Federico Calander and Andrea Esposito, who are with me at the University of Urbino, and Professor Franz Fabris from the University of Trieste. So this talk is about CBDC and the digital euro. So CBDC will be the latest technological advance in the long history of money, and it will be introduced for a number of reasons, some of which have been mentioned also yesterday. So CBDC can be thought of as a digital form of cash that complements banknotes and coins. The idea is that will be issued by a central bank, and in a federated model, commercial bank will remain responsible for relationships with end customers. So in particular, as you know much more well than me, European Central Bank planned the introduction of digital euro as CBDC. This is important because as of today, there is no single European digital payment solution that covers the entire area. And so indeed, digital euro is planned to be a fully European digital form of payment, freely accessible and universally accepted. It will come with a number of services. Some of them will be online services very similar to the already existing ones for digital payments, but it will have also to offer offline services for a number of reasons. First of all, financial inclusions. According to a report by the European Central Bank of 2024, 1/5 of EU adult people are unbanked, which is an unbelievable number, at least to me. And so they could be included with a minimal technological infrastructure on their side. Another reason is to allow for some form of anonymous or pseudonymous transaction. I mean, this kind of offline transfer would replicate some features of cash exchange. And most importantly, offline services should allow us to keep the digital euro operational during very particular situations, I mean in particular emergencies, like the temporary outage of power or network or natural disasters and so on and so forth. So the really new thing is given by these offline services, and there are many challenges and issues from operational and technical viewpoints about these offline services. They are mostly recapped in the paper. I don't have time now to present them. I can just say that most of these issues are related to the risk of counterfeiting and also on the reliance of third-party devices which are not under the control of the central bank or commercial banks, maybe. So how to achieve operational resilience in CBDC, especially for offline services? Well, a CBDC is going to run on a digital platform, so it will be based on ICT, which is by now pervasive, also in economics and finance. This is a long process that started several centuries ago with the invention of printing, which started to foster worldwide the diffusion of knowledge, industrial revolution, which widened our physical capabilities by means of automated machines, and more recently the digital transformation based on electronics and informatics, which is continuously increasing our cognitive capabilities by means of programmable devices and the basically instantaneous propagation of data over the internet. This called for a tremendous evolution of programming languages and software methodologies. The first shift was in the 80s, more or less, from sequential systems, which execute one instruction at a time, to concurrent distributed mobile systems, in which more instructions at a time are executed. And this has led to nowadays technology like our IoT, cloud computing, and so on and so forth. Another important paradigm shift has been, after the financial crisis of 2008, decentralized distributed systems, which has led to technologies such as blockchains, smart contracts, tokenized assets, and so on and so forth, in which, in the absence of an intermediary, parties who do not know each other are nevertheless capable of performing transactions, and this is made possible by the fact that consensus is achieved in an algorithmic way. So this higher and higher complexity of software has exacerbated the well-known issue of software quality assurance. By this, I mean not only the fact that the software is correct in the sense that it behaves as expected in terms of results. I also mean that the software should provide good performance, that the software should avoid information leakage, that the software should be equipped with usable interfaces. When this is not the case, we have user unsatisfaction on the one hand, and on the other hand, the fact that the software producers incur in higher costs. This is in the best scenario. In the worst scenario, we may have also human losses and environmental damages. This is the case of safety critical software. Think, for example, of space mission, flight control, nuclear power plants. If you're interested in knowing more about software disaster, please visit the Wikipedia page, which is mentioned on my slide. And so our point of view is that digital financial transactions should be considered safety critical software because possible errors in their enabling infrastructure could have very negative impact from a socio-economical viewpoint. Think, for example, of a hacker who is capable of generating CBDC token from scratch. No? There is also another very critical point here about digital transaction, which can be well understood if we compare TradFi and DeFi. So in TradFi, basically the networks connecting financial institutions are mostly private, which means that they are not directly accessible via the internet. One example of this is the SWIFT interbanking system. Nevertheless, this SWIFT system has been the target of some important attacks, like those three who are mentioned there. And overall, an International Monetary Fund report tells us that around 20,000 cyber attacks have been related to TradFi. Well, with DeFi and crypto assets, the situation is going to become even worse because these services by design are directly accessible via the internet, and so they are much more exposed to these threats. This is even more critical for central bank digital currencies, as you can imagine. So our proposal for ensuring operational resilience and software quality for central bank digital currency is the use of formal methods. Here the situation is quite peculiar because on the one hand, modern computer systems have by now reached an extraordinary power, if you think about it, in terms of information processing, storage, retrieval, and transmission. But on the other hand, there are a number of results of theoretical computer science that tells us that it is impossible to certify the quality of software in general. Why is that? Let me recall the notion of program correctness. A program is considered to be correct if and only if, for each possible input data, its execution terminates and produces, second point, the corresponding output data. Well, there is a well-known, at least in theoretical computer science, result by Turing, which dates back to 1936, which tells us that the halting problem is undecidable. This means that there does not exist any algorithm which, given an arbitrary program and an arbitrary input data for that program, is capable of telling us whether the execution of that program on that input data will terminate or not. So termination problem is undecidable. A subsequent result by Rice in 1953 tells us essentially that even if the termination problem were decidable, in any case, correctness could not be established for all programs. So a lot of research has been devoted, in the last 50 years or so to developing approaches which are capable of assessing software quality under conditions that make this problem solvable. These approaches are collectively called formal methods in computer science. They are essentially mathematically rigorous techniques for modeling and verifying computer systems with the aim of achieving a dependable software design similar to what happens in other engineering disciplines. So these formal methods are about modeling and verifying systems. On the modeling side, we have a number of formalisms such as automata, process algebras, model and temporal logic. So for example, an automaton is a state transition graph. A state is, for example, refers to the current instruction and the contents of program variables, whereas transitions describe state changes with possibly the corresponding input and outputs. A process algebra is a more abstract formalism. It is a compositional formalism because it offers us a number of combinators like sequential composition, alternative composition, or parallel composition, by means of which we can obtain complex system models from simpler ones. At an even more abstract level, we have modal and temporal logics. These are basically classical logics with the usual Boolean operators, in which there are additional operators by means of which we can express the fact that certain activities may or must be executed in a certain order along some computations or along all computations that a computing system can perform. On the verification side, we have a number of techniques like model checking, equivalence checking, static analysis, theorem proving. For example, a model checker is a software that takes as input a program model and a property of interest which is formalized according to some logics and tells us whether the program model satisfies that formula or not. And in the case that the formula is not satisfied, it provides us with an example of computation, an example of execution of the program that violate the property. Formal methods have been successfully used in a number of case studies in the last 20, 30 years, some of which have been done together with industries in very different sectors, but so far their use in economics and finance has been very, very limited. So, and here I conclude, this is our proposal of using formal methods in computer science for ensuring operational resilience of central bank digital currency. The first step consists of developing a formal model of the central bank digital currency with one of the formalisms I mentioned before, for example. So the idea is to model all the parties involved in the ecosystem, so the central bank, the commercial banks, digital ledger, user wallets, and so on and so forth. Then modeling all services that are provided, both online services and offline services. And this should be done by taking into account not only functionality, but also performance requirements and, most importantly, security requirements. In the second step, we should verify the formal model of the CBDC. This requires formalizing the properties of interest and checking for their validity on the model. Finally, in the third step, the idea is to build a model-driven prototype of the CBDC. So the prototype should be strictly based on the model that we have developed in the first phase. And this should ensure the fact that the prototype preserves the properties that have been verified on the model in the second step. So this is kind of position statements, and our hope is to be able to build a project proposal around this. So far, there are only computer scientists involved, so if there are people from economics and finance which are interested in taking this endeavor, please let me know. Thank you for your attention.
Thank you very much. Great, I call for the discussion. In the meantime, if there are some questions from the audience. Okay, okay, yeah, sure.
Thank you so much. Yeah, formal verification, very hard topic, but very appreciated in software because it does secure a very good system, especially in blockchain system. So I'm curious in the digital euro, what do you think is the most important pieces in the technology that needs formal verification? You mentioned a few, but I'm curious about what do you think about which ones are the most important one to formally verify?
We are at a very initial stage of our study, so I'm not able to answer your question now, but a lot of emphasis, I think, it should be put on offline services, because they're kind of new services that have to be offered in this technology, and it is not clear how to implement them. So a lot of effort should be put on them, I think. Thank you.
Okay, I leave the floor to co-Pierre Georg.
Yeah, thank you so much. It's a great pleasure to discuss the paper. I don't know how many economists were actively involved in actually building a retail CBDC, but I was. In South Africa, we did this in 2021. There was a feasibility study for a digital rand, where the situation was a bit similar. We have a very high percentage of people who are unbanked or underbanked. A lot of them don't have smartphones. How do you get them onto a retail CBDC? My group also developed the solution that Ripple then used for their retail CBDC in Bhutan and Palau. So this is very good that I can discuss this paper. It's very close to my heart. And you speak of many problems that we faced actually when thinking about the design and thinking about how do we approach this. But let me preface this a little bit. And this is to put into sort of context how we think about retail CBDCs. What are the sort of programs that we want to solve? This is for the digital euro, and I have to say this is version 0.8. This is already outdated because it's not going to be UTXO based. The engine looks a little different. I think the design around it still will still look the same. But the idea is that you have this core settlement engine, and around that you have sort of a front end where you have wallet service providers that are doing things like lookup. I want to send Martin some funds, but I don't know your wallet address, so I know your name or your phone number, so I could look you up on a phone book and send you money. That was a typical use case. How do you facilitate that? For the digital euro, the wallet service providers will do that. And then you have sort of wallet providers that provide this end user facing, facilitation of payments. And these use cases, and this is very typical in South Africa, we had very similar sort of user stories that we had to implement. You have an end user, he wants to transfer from A to B using a wallet service. Then the wallet service asks for in this model, the UTXO address. That is sort of found by the wallet service provider of the recipient. Address is sent to the wallet service provider of the payer, then the package is built, is sent to the settlement engine, is returned to the wallet service provider with the confirmation, okay, this transaction has happened, and then the front end gets a message, okay, payment received, everything's good. So that there was a catalog of these sort of user stories, both for online, mainly payer initiated, or it could also be payee initiated. You go to a retail store, you're going to pay with your offline digital euro device, and they initiate a pull payment. Recurring payments were a use case. Offline payments were a big use case. In Europe, I recommend you chat with the folks at Giesecke and Devrient, because they're actually building the offline digital euro, and I know that they have been thinking about exactly these kind of questions as well. I'm be happy to connect you. There's some interesting work there. But I have two questions. So I also have a sort of hobby interest in software complexity. Right? So again, this paper was a perfect fit for me. But here's how I think about this. When you look at this in practice, how do you build these CBDCs? What are the solutions that you have to come up with? There are sort of different areas of where bugs can arise. The first is on the program complexity. So you could actually implement the wrong program, or a program that is internally inconsistent. This is, I think, what you speak about predominantly, right? That we want to verify that the program is implemented correctly. Well, then that the program is correct. Then on top of that, you could actually build the program incorrectly. You could develop the software in a way that doesn't actually implement the proper program, even though the program itself could be correct as far as you can tell. And then even if you have that, even if you have a program that is supposed to be correct, it's correctly implemented, there could still be user mistakes. When we had our first wallet in Palau that was used, we built an app for a phone, and the first user who uses our CBDC uses a desktop computer for a reason I will never understand. It was totally never thought of that way. But the very first user opens their web browser, wants to send via the web browser. It makes no sense. There's no on-ramping for a card or anything like that. That was the first thing that happened. So on the computational side, you could also have additional bugs. What I would think would be super helpful for people who are tasked with building these CBDCs right now is to sort of have a clear taxonomy of, okay, this is where bugs come in, this is sort of what you can do about it, this is sort of the best method you can use to deal with these bugs. So that's the first comment, that it would be really helpful to think through the whole stack of where these problems come from. The second one is, so what in the paper is really CBDC specific? Yeah, right, so so I'm not a computer scientist, but an interested amateur, right? So I know the literature a little bit, and I thought, yeah, this example is nice and interesting and illustrative, but it's not really about a CBDC. Nobody would build this as a sort of parallel system in the way that you studied it, and the buffer that you have, the buffer capacity on a public ledger can never be exceeded, right? So what would also help a lot is if this was more CBDC specific, right? And especially for folks like me who are interested in this, I think it's missing clearly, but that would make it even more useful. So, thank you.
Thank you very much. So I represent the presenter, which is George Copier. Is presenting the infinite money glitch. So the floor is yours, please.
Very good. Yeah, thank you so much. This is a fun paper that I wanted to write just because I was curious about the infinite money glitch. I was thinking of the financial crisis, a global financial crisis, 2007, 2008, where with hindsight everybody said, how did you guys not see that there was a problem? So I thought if something is called the infinite money glitch, I do not want to be held accountable in like 5 years when something falls apart and somebody comes and says, like, how did you not see it coming? It was called the infinite money glitch. So what I was set out to do was to write a little model that helps me understand the mechanics of this infinite money glitch and help me understand what it actually is, and then eventually helps me understand under what conditions could this infinite money glitch turn out to be a very finite money glitch. And that's the paper in essence. So the infinite money glitch is a self-reinforcing mechanism where a company, strategy, issues convertible debt, initially, nowadays also stock, but issues convertible debt, use that money to purchase Bitcoin. As a result, have volatility of their stock price that is higher than it was before. So you have a normal stock price, it fluctuates. When you buy a very volatile asset, Bitcoin, you reduce the free float of Bitcoin in circulation, making them possibly more volatile. You make your own stock more volatile. That in turn makes it more interesting to hedge funds to invest in you because they can short the stock, be delta neutral, and still make a bit of a profit through gamma scalping. So the hedge fund can sort of use that volatility, and the higher it is, the better for the hedge fund. So what MicroStrategy is doing in essence, it found a nice way to take something that is volatile, turbocharge the volatility, and find buyers for that volatility. And in doing so, the hope is that, you know, once you start this machinery, if it's large enough, it will eventually become self-perpetuating, you know, like a fire that draws heat and becomes even hotter. So that's the initial idea. It's a very narrow business model. You issue debt to buy crypto assets, mostly Bitcoin. There's a few other sort of imitators and for other assets. By now, and I had to look it up yesterday because it keeps increasing all the time, so far, increasing all the time. Strategy had 709,000 Bitcoin. It's still part of two big indices, NASDAQ 100, MSCI World, and the ACWI. That really matters because that creates a sort of baseline demand for the stock of MicroStrategy. So you and I are likely to have invested in Strategy just because it's part of MSCI World and All Country World. Why do we care whether they have so much Bitcoin? I mean, good for them. I'm happy if they have them. The fear is that because there's a lot of other companies by now that have significant Bitcoin holdings, a failure of MicroStrategy and a possible fire sale of their holdings could lead to quite significant spillovers to things even normal economists and central bankers care about. Right? So that is sort of the concern, is that there could be systemic risk. So I want to know under what conditions does this glitch break down. That it could break down or could start to break down, there's indications for already. So this is the stock price of Strategy versus the price of Bitcoin, and Strategy stock price has been sort of coupled since they started buying Bitcoin in large amounts, but now it has started to decouple, which has to do most likely with lots of imitator companies coming in doing the same thing. So hedge fund capital is finite, and that means that they can't do the same model they used to do in the beginning to sort of keep this cycle going. As a consequence, stock price has dropped from a high of, I think, 460 or something to, I checked yesterday, 160. So some of my money was burned in that process too. Thank you very much. And it accumulates. I have some numbers on how much retail investors have lost so far in this whole scheme. And the idea initially the idea is quite ingenious, right? So you issue convertible debt, and you can do it at a long maturity, 5 years or so. So MicroStrategy is in the middle. They issue convertible debt that is bought by hedge funds because the implied volatility of the stock is lower than the realized volatility. That makes it quite attractive for them to buy it. They take these proceeds and invest them into Bitcoin so that the price of Bitcoin follows this process here. There's a drift upward, let's say, if you want to be generous, there's an upward drift in the price of Bitcoin. And then the price depends on sort of the available free float. Sorry, it's a bit small, it's not so easy to do. So the available free float, which is reduced because strategy buys and buys and buys more Bitcoin. So the free float goes down. Consequently, the price goes up as a result of this buying. And in t equals 1, the same process sort of repeats. So you have this propagation of both stock prices and Bitcoin price from one period to the next. They do the same thing over and over again. The infinite money glitch, in essence, is this thing here, that the stock price increases proportionate to the increase in the price of Bitcoin, and there's an amplification mechanism involved in this. So if we want to understand the infinite money glitch, we have to understand this amplification mechanism. As I said in the beginning, this was quite easy and nice, and everything was peachy, 5 years duration. You didn't have to pay any interest on these convertible bonds. That sounds like a good proposition. Lately, however, things have changed because, as I said, the hedge fund capital seems to have dried up a little bit. It has become more difficult for them. They haven't been admitted to S&P 500. That was the big gamble, that they would be admitted to that. Then there would be a lot of passive funds flowing in, which means there would be much more demand for the stock. So lately they have to pay interest on these debt issuances, either in form of preferreds or in form of convertible bonds, where they had to pay interest. So recently, this whole thing seems to stop a little bit, because now you have sort of you raise money from hedge funds and you buy Bitcoin, but eventually the issue is if this becomes too small and you have a large amount of sort of repayments that you have to make, there are very few things you can do other than eventually selling Bitcoin. And fun fact, I didn't know that, they already have sold Bitcoin in 2022 when they were called Macro, or there was a subsidiary called MicroStrategy. Didn't know that, is in the SEC filings. So this is the fear, that eventually, as you have to pay interest, this glitch stop working and they have to sell. So in the model that we have, it's a very inelegant model in a way, but I try to capture sort of realistic-ish kind of features of this market to see what I can do to break it. So in the model, you have the firm that does this convertible issuance to purchase Bitcoin with it, and that has a price impact on the price of Bitcoin with this sort of drift, and then this effect from buying. Now, I have to say that I think there's a difference in the effect on the price, whether you are buying or whether you are selling. As long as MicroStrategy is buying, that's probably going to be fine. As soon as they start selling, things could become a bit trickier. So one of the things I've done is I've introduced a parameter that checks whether the downward drift, the psychological effects of Michael Saylor saying, you know, you should never sell your Bitcoin, and then having to do it. If that effect is large, that you will see that is sort of one of the things that can really break everything. There's this amplification of higher Bitcoin volatility translating into higher stock price volatility that then is useful for the hedge funds, because as long as they can short the convertibles and as long as the realized volatility is larger than implied volatility, it's profitable for them. So as long as this mechanism is in place, the infinite money glitch works. In the model, there's market clearing with some constraints, including a borrowing constraint. If you don't have shares to borrow, that would become an issue. All right, then you can sort of do what sort of stress test people like to do. You can sort of track price of Bitcoin, the stock price of the company, I include a solvency check at the end of the model to see sort of under what conditions this fails. So I don't know how I'm doing on time. 5 minutes? 3, 2, okay, that's fine. So you can solve this model actually computationally pretty straightforward. Analytically, not so much, because for that it's too involved, but it's a straightforward 3-period model where you have forward propagation of these price effects, and you can solve the issuance at every date. So there's nothing fancy happening here. And then if you build a very inelegant model, you have to calibrate a lot of parameters. That's sort of the price you pay. Luckily, many of these parameters you can actually find and you can calibrate: initial stock prices, conversion premia. You have to put in place a few assumptions, something like about hedge fund capital, how much is available. I set it large enough so that it wouldn't cause a problem. And they can study sort of the different model parameters. I've 9 free model parameters, and I only want to show you maybe the 1 or 2 results here. So the one result that for me really matters is this is the price. This is sort of the price of Bitcoin at 3 dates: beginning, interim, final date. As you increase this parameter of the psychological effect. If the psychological effect is large, you won't see it at the interim, but it will have a very significant effect at the final date. Basically what's happening here is if the effect is large enough, you have sort of at the interim period, things go well, the strategy levers up, they sort of issue more debt, buy more Bitcoin. If something goes wrong in the final period, it gets really, really bad. And it gets more bad the better it goes at the interim period. That's sort of the gist of it. You can do this sort of for different calibrations. You can also look across sort of the whole parameter space, because once you have an inelegant model and you just sort of solve it numerically, you can do it everywhere. Computation is cheap, and you can find sort of parameter space regions where things become more fragile than in others. And then you can show sort of that it's really largely this psychological parameter that drives this, as well as hedge fund capital and available shares. So where are we now? MicroStrategy was not admitted to S&P 500. Every quarter they are being reviewed for being kicked out of NASDAQ, because to be a NASDAQ you need to be a tech company, and to be a tech company you must not be a payments company or a financial company or a fund. So it's possible that they're going to kicked out like Visa and MasterCard were a couple of years ago. So they're not admitted to any new indices. So far, 17 billion in losses to retail investors. Strategy as of today, or as of a few weeks ago, needs to pay 690 million a year in interest, which has to come from new investors. So you have to raise new money to pay off old monies. Economists do have a term for that. And there's this nice meme online that if you align sort of all the instruments they're using in sort of order of their maturity, well, you can see where we are going. And with that, thank you very much.
Thank you very much. Thank you. I invite the discussant, Martin, and if there are some questions.
Thank you so much for a brilliant presentation, having looked into this. Talking about where we're going, I once read Michael Taylor claiming that his business model could resist a collapse in Bitcoin price up to 90% for 4 years. He had enough buffer, I guess. Have you managed to look into this and verify?
Yeah. Well, so the thing is that his share price doesn't depend on the current price of Bitcoin. It depends on the price of Bitcoin at the time of issuance. So as long as he doesn't have to issue new debt, it's going to be fine. And they recently built this cash reserve of like 18 or 21 months or something like that to protect them from that. The issue is not so much that that they would have to sell because of a cash crisis, but because they lose control over the company. Shareholders, like Saylor has no majority anymore at MicroStrategy to start with. If the stock price tanks, they will be ousted, and then they just might sell. In the SEC filings, I've cut it because it's not because of time, but in SEC filings we're already quite clear, say we might sell Bitcoin and everything. I mean, it's a legal thing. On TV you can say whatever you want. To the SEC you have to sort of say the real thing. Thanks.
Thank you. Please.
Thank you. Well, it was a great pleasure to have the opportunity to discuss this paper, The Infinite Money Glitch by Copier. Just this week, January 20th, Tuesday, it was actually like another filing with the SEC by Strategy, and kind of they announced that they had acquired 22,000 bitcoins for a total price of about $2 billion over the past week. We're talking about substantial inflows. How do they finance it? Well, they have kind of an at-the-market offering program. It is summarized like an ATM. It works a little bit like an automated teller machine, but then for a company. They have some shares with an investment bank. If they want to have cash, they call the investment bank, and the investment bank basically issues the shares by selling them in a market at the prevailing market price. Can some have some price impact? Different things that they sell. So this particular case, they've been selling common stocks, and they've also been selling, like all the other things, basically there are kind of different forms of debt obligations. Okay. They sold, also sold 2 billion of like new securities in the market to finance the purchases of Bitcoin. Why should we care about this? Well, if you're an investor in the crypto market, then basically if you look at the kind of the inflows, the net investment inflows that come, for example, from ETFs, plus those from MicroStrategy, there seems to be kind of at least some eyeballing relationship between how large the inflows are, how much ETFs are buying, how much MicroStrategy is buying, and what's happening to the price of Bitcoin, right? If this is kind of increasing the holdings by ETFs plus MicroStrategy, then you also see the price increasing. If they're not buying a lot, it seems to be like more flat. So as an investor, probably you care about what these other market participants are doing. This is basically where the paper of Copier comes in. So basically he's the first one to design a stress test model for digital asset treasury companies. Because basically what they do, well, they invest in Bitcoin, but they use a leveraged position. And then the focus of the stress test model is the convertible bonds. Crypto prices, they are known to respond quite strongly to buying and selling pressures. There's a crypto multiplier effect, there are liquidity pressures. And you can imagine that there are going to be potential feedback effects. So if these companies, if MicroStrategy is expanding by buying Bitcoins, basically they're pushing up the price. So that's going to be great for the future price of MicroStrategy and the future price of Bitcoin. But if they are forced to sell by some reason, it's going to be very bad, right? Because they might be forced to sell and then to sell more and more and more. So you can have some downward spiral. And then basically the research question, I think, in the paper is, can reasonable calibrations result in a downward spiral where a digital asset treasury company starts selling after a negative shock and then pushing down the crypto prices, ending in a potential default, or at least a lot of losses to investors? So what are my main comments? So one big question that I have, like, well, if you look at what is basically like in this model, what are the options that a company could have? Because one of the things they can do if they can no longer raise more, if they have to repay debt and they cannot kind of roll it over, then one thing they can do is kind of selling Bitcoin. But another alternative thing that you could do as a company is basically use this ATM program, expand this ATM program to sell more stocks. Perhaps at severely discounted prices, but it might be another source. So you could imagine that there's kind of some trade-off between like the market, the liquidity in the equity market on the one end and the liquidity in the crypto market on the other hand. So you might want to balance, if you're kind of the manager of the company, you might want to balance like your sales of Bitcoin and your sales of additional shares in the market, just to kind of maximize how much cash you're getting without a big price impact. Second question, like if you think about like more from a theoretical perspective, I just would be interested, like, is basically, are you kind of identifying something that I think I haven't seen in the literature is basically that convertible bonds, that they can trigger like a classical case of multiple equilibria. Because basically, like if there are no fire sales anticipated in the crypto market, then the current crypto market price might be very high. Then these bonds, they will convert into stocks because of the convertible bonds. They work in a way that if the price increases of the stock, then they convert into shares. And then also the company doesn't have to sell any crypto in the end because they don't have to repay the debt. Because nowadays, convertible debt is kind of converted into equity. So that's kind of a good equilibrium. But you could imagine like that at the same time, there might be a bad equilibrium as well, where basically you anticipate fire sales. So just the difference here is like that is your anticipation, do you anticipate the fire sales or not? If you just anticipate the fire sales, then perhaps current crypto prices are going to be low just because you expect that the bonds need to be repaid with cash and that fire sales will occur by then. The third question that I have in this comments is like, if I look at the current paper, the current results kind of it's a lot of results, but in the end, like if I'm the reader, I would kind of have the question like, well, if you want to have as realistic as possible model, what could be the really cool questions that you could answer with a model like this? Personally, I would think, well, how far could the Bitcoin price drop before strategy runs into severe trouble? Another thing that you hear a lot in the market is whether a ratio between the NAVs, the net asset values, and the stock price, whether that's larger than one, whether it really matters. But probably there are a lot of people here in the audience that have much more interesting questions. So I would say, like, if you think about the cool question that you can answer with this model, talk to Co-Pierre in the break. Overall, it's a really cool idea and a cool title of the paper too. It's the first paper to design a stress test framework for digital asset treasury companies. The conclusions may be very impactful for the crypto market, for investors. Will Co-Pierre become instantly famous is my big question. If you're an investor in a digital asset treasury company, you hope not, but it might be the case. Thank you.
Thank you so much. So I thank all the speakers, discussants, and organizers for this fruitful session. And I leave the floor to the keynote speech.
Let me introduce our keynote speaker for today, Leonardo Gambacorta. He's head of Emerging Markets Unit at the Bank of International Settlement. But prior to this current role, he was head of Innovation in Digital Economy, where in that position he wrote a lot of papers on the topics that we are discussing in these 2 days. And then I think, well, there are lots of things saying about you and your many papers, but then I think the best thing to do is let you have the floor immediately, not to lose some time, and then listen to what you have to say about stablecoins. We start our second part of the conference. As we said, this is a mingling between academia and practitioners and regulators. Now we have the voice of the regulators about stablecoins, and then we will listen to practitioners in the panels discussing the future of traditional finance with DeFi. So Leonardo, the floor is yours.
Thank you very much. So the difference between an academic speaker and a policy maker speaker is that I have to sit and stay straight to the outline. So it's a great pleasure and honor to be here and to take part to this conference. And today I will talk about stablecoin growth and policy challenges. Is a very important topic from a policy point of view. And I would like to base my talk on research that has been conducted at the BIS. And of course, being a policy talk, the usual disclaimer applies. The views expressed in this talk are mine and do not necessarily reflect those of the Bank for International Settlements. May I have the pointer? May I have the pointer? Okay, this is the pointer. Okay, great. So let me start with some facts on stable coins. So stable coins are crypto asset tokens that circulate mainly on public permissionless blockchain and promise to maintain a stable value relative to a reference asset. And of course, we have seen that stable coins provides a lot of opportunities. So they are basically native to the blockchain, and then therefore they are the dominant means of exchange within this crypto ecosystem. And what is very important is that they can be integrated with the smart contract, enabling what is called the atomic settlements, and this is very important. And however, in order to gain stability, despite the fact that stablecoins are in the decentralized finance world, they are linked to the real world. And most stablecoins are pegged with the US dollar, and promising investors $1 for each stablecoin on demand, much like what is for the money or money-like claims, such as the bank deposit or the money market funds, the share of the money market funds. And the major stablecoin issuers back their token primarily with fiat-denominated short-term assets, such as the treasuries, but also repos and bank deposits. So these are the three main assets that are on the asset side of a stablecoin issues: deposit, repos, and treasuries. And so macroeconomically, they're still not relevant at the moment, but there is a buff, because stablecoins' rising market capitalization and the increasing interconnection with the traditional financial system have reached the stage where there are possibilities of potential spillovers to the financial system, and this cannot be longer ruled out. We have to take into account in terms of regulation. And indeed, in response, many jurisdictions have introduced or are in the process of developing or updating a regulatory framework for crypto assets and stable coins, building on the high-level principle that are established internationally by the international standard setter as the Financial Stability Board, the CPMI IOSCO, and the Basel Committee on Banking Supervision, that are establishing kind of a high-level principle to follow. So in the rest of my talk, I would like to describe first the market for stable coins. Then I would like to provide you a high-level overview of the main policy challenges arising from the stable coin. So this is the outline of the talk. And I start with the analysis of the stablecoin market. This slide shows three elements of the stablecoin market. The first one is that we observe a remarkable growth in the last years. You know? So you can see that in the left panel, the panel A, the plain number of stablecoins in active use has increased from around 60 in the mid-2024 to over 170 in the mid-2025. And some recent sources point to more than 200 stablecoins, but some of them are very niche stablecoins. So the second fact is the concentration in a few issuers. So what is shown in the second panel is even more striking. So it's the sharp increase in market capitalization, which went from 125 billion less than 2 years ago to around 260 billion in the mid of 2025, but today is around 300 billion. And this panel also shows that despite the proliferation of this number of stable coins, there are a lot, the market remains highly concentrated, with around 90% of the market capitalization that accounted for by just two issues, that is USD coin and the USD Tether. So these two, these two stable coins, they account for around 90% of the market. It's highly concentrated. And the third element is the US dollar dominance. You can see this in the panel C and the panel D of this slide. So the market is dominated by the US dollar. That is the main reference currency, and almost 70% of active stable coin, if you consider the count of the stable coin, are denominated in US dollar. And when you look at the market value, this is even more, is 99% are pegged to the US dollar. So these are the three elements that we can see is a remarkable growth in the last years, concentration in a few issuers, it's 2 issues, 90% of the market, and the US dollar dominance, 99% are US dollar denominated. So let me pass now to the analysis of another fact that is this par convertibility that is not always reached. So despite their name, stable coins, so they promise a stable value, stable coins have experienced episodes of very high price volatility. And you can see this from the left panel. No? You can see that indeed some types of stable coin, they're considered to be stable. They exhibit a very high volatility, and in some cases, this volatility is even higher than the one we observe for the stocks. And for example, in the cases of algorithmic stable coins. And then also other stable coins have a volatility that is even higher than Bitcoin. That is a form of crypto asset that is typical, that is unbaked. So it's this promise of par convertibility is in most of the cases not reached. But you can say, well, we want to focus on the fiat-baked, that are the ones that are the most stable, no? And you can see what happens for the least volatile stable coin, that is the fiat-baked, that are in the right panel. And you can notice that even for the fiat-baked stable coins, that are by wide margin the least volatile within the stablecoin space, they very rarely trade exactly at par relative to the unit of account in the secondary market, even when the market is very tranquil, or more recently when the market has matured and there is a lot of liquidity into the market. So they never trade at par. And the fact that actually they trade at the value of 1 is quite an exception rather than the rule. And why this? Because stablecoins are traded in the secondary market, and therefore they have a market price. And this is very different from the current forms of money that we use for everyday transactions, such as, for example, bank deposit. They don't have a market price. So, for example, there is no difference for a deposit of $100 that is in bank A or in a bank B. So $100 is $100. So at the end of the story, when we pay someone, a dollar is a dollar, but this is not the case of stablecoin. There are different kinds of stablecoins. Stablecoin green, blue, red, they have different value. So of course, these as a for policymakers, these raise some doubt on stablecoin's ability to serve as a reliable means of payment and provide what is in the literature is called the singleness of money. That is, $1 is $1. So when I pay someone with $1, this is the transaction is done and is finished. But when I pay someone with a stable coin, you never know if this is at par or it's relatively close to $1. So, but the growing importance of stable coins raises also other policy challenges. And one important policy challenge is monetary sovereignty. So a broad use of foreign currency denominated stable coins can reduce the effectiveness of domestic monetary policy, especially in those countries that experience high price and currency volatility. For example, one interesting use case is the case of Argentina lately. So from the left graph, you can see that the stablecoins cross-border use has been growing with the quarterly trading volumes that have exceeded the $400 billion for the two big coins that I have indicated before. And from the right graph, you can see what are the drivers of stablecoins for both the sending country and the receiving country. And in this kind of a survey that have been studied, the recourse to stablecoins in cross-border transaction tends to rise during episodes of high inflation and foreign exchange volatility. So the use of stablecoin in advanced economies is mostly related, and the discussion is mostly related to the characteristic of the stablecoin, how good they are in terms of payment, digital form of money, how good they are in terms of being the digital form of money to be used in a smart contract and so on. But for emerging market economies, there is a serious problem that is about monetary sovereignty, and we can observe that the use of stablecoin is very much related with episodes of inflation and foreign exchange volatility. So a great concern for several emerging market economies is a currency substitution. So it's a sort of a dollarization of the economy via stablecoin. A broad-based stablecoin adoption could provide really an easy way of access to dollar-denominated claims for the non-US residents. And this potentially will weaken the effect of the domestic monetary policy. So what the emerging market economies could experience? So first, when you have a change in domestic interest rate, these have smaller effect on spending, saving, and credit condition, because there is a detach from the level of the interest rate or the change in reserves and the aggregate demand. And stablecoin could also undermine the effectiveness of foreign exchange regulation or even capital controls, because, for example, they can be exchanged cross-border without a lot of controls. And this, of course, reduces the possibility of policymakers to be able to manage the external balances. And this is very important for emerging market economy. So stablecoins can undermine the monetary sovereignty by shifting the money demand, intruding into the payment system, and also impede the management of capital flows. So this means that this push out the control of these three elements outside the perimeter of the domestic currency and the perimeter of regulation. This, of course, it is especially for economists that experience economies that are very fragile. An additional policy issue I would like to talk about relates to the stablecoin impact on the markets where they invest their banking asset, especially because the sector is highly concentrated. So being highly concentrated, when the stablecoins buy, for example, treasuries, or they invest in repos or deposit, they really move the market. So the largest stablecoins in the world, they hold high-quality dollar-denominated asset, in particular short-term US treasuries, treasury bills. So you can see in this left panel, that is for 2024, these stablecoin issuers net purchases of the Treasury securities have been comparable with those of investors in some large countries and large global money market funds. For example, they are similar to the Treasuries bought by China or by global money market funds that are very important. So the stable coins could really have a material impact on market yields, and this potentially, of course, affect the pass-through of monetary policy. And this is what I would like to show you in this middle panel. We have done some studies at the BIS. We've seen what happens when you have, for example, an inflow of 3.5 billion of stable coin. This corresponds, just to give you an idea, if you look at the time series, 2 standard deviation of the stable coin series. And this produces a reduction in the Treasury bill of about 2.5 and from 2.5 to 5 basis points. You can see this in this graph, and this is statistically significant. So this is good news for the U.S. Treasury. You know, you have a lot of stable coin, and there is a reduction in the cost. You know? Well, unfortunately, the effect is symmetric. So this means that the reverse happens in the case of an outflow, and there is an increase in yield, because in the case of outflow, stable coins are forced to liquidate their holdings, and this happens also very quickly. So all these raise concern about potential fire sales under adverse market condition. And still, just to give you an idea, so we have seen that the market capitalization of stable coins is $300 billion. So the U.S. debt, the whole U.S. debt is 30 trillion. So tiny bit. But the T-bills are 6.7 trillion. Still not comparable with the 300 billion. But these stable coins, they move the market. They move the market. They change despite the low capitalization, they change the yields. Another fact is that in the right panel of this slide, we can consider the impact on stablecoin market capitalization in the case of an increase in interest rate. Because now one could ask, okay, these stablecoins are money-like instrument, but they are different with respect to the deposit and the money market funds. What happens when you have a change in interest rates? So when you have an increase in interest rates, the market capitalization of stable coins decline. You can see this from the right panel, no? And we have to remember that as far till now, stable coins are non-interest-bearing assets, so they don't grant us interest. So when the monetary interest rate increases, this increases the opportunity cost of holding the stable coins. So they behave very similarly to deposits and completely different with respect to the money market funds. So in the case of the money market funds, the opposite. No, when there is an increase in interest rate, the money market fund, they buy assets that are that they grant interest rates that are very much correlated with the money market interest rate, and therefore they grant more higher interest. But in the case of the stable coin, because they are not remunerated, the opposite happens. No, so one could think, okay, maybe that in the future. This could put pressures on stablecoin issuers to push them to grant interest rate in the future, or other forms of reward to stabilization. This could raise really new regulatory and financial stability question. And one point that is very interesting, there is a new research at the BIS. We look at the emergence of tokenized money market funds share that they pay interest rates. And when this market will gain momentum and will growth, this could put really further amplify stablecoin sensitivity to rising opportunity costs. So it's a very important point. And let me just conclude with the other two parts of the asset where the stablecoins are invested in, that is the repo and the bank deposit. So I want to make a point that the management of stablecoin reserves, you imagine you have treasury, repos, and deposit, can further deepen the interconnectedness with the traditional financial system that is beyond this mechanism on the treasury holdings, but via the repo market and the deposit market. So some stablecoin issuers, they rely on reserve repo to generate additional income. So what they do, basically they lend cash and receive treasuries as collateral. And during market stress, they can unwind reserve repos. This could really strain the repo market, the liquidity, and with the spillovers on other forms of short-term dollar funding, because the movement is quite huge. And other stable coins, they buy deposits, so they have deposit holdings. And in some cases, this is mandated by regulatory requirements in some jurisdiction. So you can imagine this creates a big client for banks, big depositors. Is they basically they take the money from a lot of small depositors that are, imagine that I transfer my deposit to a stable coin, and then they invest as a stable coin issuer this big deposit into a bank, and of course through this reserve management, changes into this deposit holding could increase interconnectedness and amplify the transmission, because it is not as a single little depositor that unwind this position with a bank. It's really a giant. So this means that in general, through the reserve management of this asset, they really amplify the interconnectedness with the traditional finance, in a three-way, that is repos and the treasuries and the deposit to the banks. So this is not the end. There is also another risk that derives from cybercrime. We all think that the bitcoins could be the one used for illicit activity, and the stable coins are the good one. However, we have evidence that suggests that already for the past year, stable coins have risen to hold the first spot in this regard as a cybercrime. And there are reasons for this. So, as a digital bearer instrument, stablecoin can circulate freely across borders on permissionless public blockchains into different exchange and into self-hosted wallets. And this, of course, this makes them prone to some weakness with respect to the know your customer compliance, the anti-money laundering, and of course this makes them increasingly attractive for criminal and terrorist organization. So while in contrast with the traditional financial system, where there are illicit flows, but these are monitored at the time of the account updates by the intermediaries, they see the exchange. The burden in combating the illicit flows in the crypto space currently is very limited because of the limitation in the anti-money laundering. So this is a point that should be considered by regulation. So this brings me to a potential alternative that is increasingly discussed, that is tokenized deposit. So let me just, there is a study at the BIS that we have conducted through the years. There is a paper by Garrett and Shin, 2023, that explains what are the tokenized deposit. Let me just give you the intuition. So tokenized deposits are a digital representation of commercial bank deposit. Imagine that you have a deposit in Bank A, you can have the possibility to have a digital form of the deposit. So why this is important? So first, it is fully denominated in domestic currency and could be recorded on programmable platform or distributed ledgers, but they remain claim on banks with the existing two-tier system. So what does it mean? It means that first, they are not bearer instrument. They are always linked to identified account holders, subject to the same legal, supervisory, and compliance framework as traditional bank deposit. So this means that the bank, they do the anti-money laundering, the KYC, and so on. But at the same time, they are programmable. So this is, at the end, why we need the stable coin. Because they are a programmable form of money that in a platform can be used with smart contract. This is what is important for society, no? To be used in a smart contract, we need a digital form of money. We can choose among these three. Is a stable coin, tokenized deposit, CBDCs. But CBDC, they're very good in terms of a digital form of money, represent a sort of a liability to the central bank, but a lot of central banks, they put a cap. So if I want to buy an asset of 1 million, I cannot use CBDC retail because there is a cap. So I need to use another form. Stable coin, fine, but we have a problem of anti-money laundering. The alternative is tokenized deposit. Tokenized deposit is programmable, can be used in a platform, and the settlements is done via CBDC wholesale. So what we really need in the future monetary system is necessarily a form of settlement in central bank digital money that is wholesale, not necessarily retail, because also a lot of CBDC, they are not programmable. So tokenized deposit can be used together with the CBDC wholesale, and the settlement is done in this form of central bank money with a burn and issue model. That is, for example, I have a tokenized deposit of Bank A, you have tokenized deposit of Bank B. I burn my tokenized deposit of Bank A, I issue a tokenized deposit of Bank B, I give it to you, the settlement is done with the CBDC wholesale, and therefore the exchange is done, but in a form of a digital form of money that does not sacrifice compliance and oversight, and it has all the institutional safeguards, and does preserve the two-tier system. So this is a possibility that we can have, in alternative to the stable coin. Okay, let me conclude. So stable coins have grown rapidly because they address frictions, particularly with the crypto ecosystems. They enable efficient settlement, operate around the clock, and their programmability allows for atomic settlement through smart contracts. These are genuine technological advantages and help explain their widespread adoption. At the same time, as stablecoins scale up and become more interconnected with the traditional financial system, they raise first-order policy challenges. So first, the promise of par convertibility, this promise remain fragile. They exposing them to run risk, and $1 stablecoin is not a dollar, and the singleness of money we have seen is not fully respected. Second, their growing cross-border use can undermine monetary sovereignty and accelerate currency substitution, especially in emerging market economies. And third, their design as digital bearer instrument creates some structural vulnerabilities for anti-money laundering, combat financial terrorism, and fight in general against illicit finance. So the policy implications are clear. So stablecoin increasingly behave like money, and this instrument they behave like money, require money-like safeguards. There is no regulatory light touch once scale, concentration, and cross-border use become significant. So this means that we cannot regulate them lightly, but we need to regulate them appropriately. And looking ahead, tokenized deposit illustrate a possible path forward. These tokenized deposits show how programmability and atomic settlement can be achieved within the existing two-tier system while preserving compliance, oversight, and trust. And let me conclude with an idea that we need really to embrace technological progress, but so technology is good. It is the way we use technology that we have to consider. But the central challenge for policymakers is therefore not innovation versus stability, but how to foster innovation while preserving rather than weakening the two-tier monetary system. So stop here. Thank you a lot for your attention, and open to a couple of questions if you have.
Yes. Ferdinando.
Thank you for your very informing presentation, very interesting quantitative observations. I have a question. I mean, if we think about the public debt of Italy, 23% is owned by banks. And banks, they do operate on fractional reserves. Stablecoin issuers, instead, they operate with full reserves. So why is Bank of International Settlement more concerned about stablecoin issuers than bank owning public debt?
The easy answer is that there is a little difference. The banks are regulated.
So are stablecoin issuers? With MiCA regulation, stablecoin issuers are regulated in Europe. With Genius Act, issuers are regulated in the United States, so they are regulated. Maybe the regulation is not up to some standards, and so it's a regulatory issue.
There is, I don't know if you have followed this debate. But,
a lot.
Yeah, I imagine, given the question. So, how should stablecoin be regulated? Because there is a discussion about this. So the starting point is that stablecoins increasingly behave like money. We have seen that they promise par convertibility, they are used for payments and settlement, they can reach scale rapidly across border. So this places them closer to the bank deposit, no? Bank deposit or money market fund. So regulation must therefore be money-like, not tech-like. So the regulation should have certain characteristics on the stablecoin. So the G20 has established some principle about how to regulate stablecoin. It is not that stablecoin cannot exist. Stablecoin should be rightly regulated with a certain kind of characteristic. And this is a work that has been done by the Financial Stability Board, providing high-level recommendation. What are these points? So the first point is about a clear legal basis. Stablecoin might be issued with a clear legal framework with enforceable redemption rights. First point. Strong governance and risk management. The issuer must meet a standard comparable to other systemic financial institutions, should be regulated as bank. High quality, liquid reserve backing. Reserve should be safe, liquid, transparent, and sufficient to meet redemption under stress. Do you know what is invested in, for a USD Tether or other stablecoin issue? And then should be effective supervision and oversight. So authorities must have the power to supervise the issuer, the wallets, and key service providers. And of course, there is another little point that I would like to make, being in Basel, is that there should be cross-border cooperation, because given their global nature, regulation cannot be purely national. So, and then on top of this, there is another point I would like to make, that this is a personal point, that is, in principle, one could say we should apply same risk, same regulation, but in this case it's not sufficient. Why? Because it's not sufficient. Because the stable coin, they touch 3 points of the financial system. They combine payment system risk, bank line run risk, and asset management risk. So no single traditional regulatory category capture all this. So this means that stable coins must require a more stringent regulation than traditional instrument, because of these 3 characteristics. It is not that stablecoin cannot exist. They should be regulated.
Yeah, I think my question would come actually from the opposite side. Why do we give stablecoins such a pass? If you look at Tether's balance sheet and you were to treat it as if it was a bank, it would be severely undercapitalized as of today. What I've often wondered is, why don't we give stablecoin issuers access to central bank facilities? There are several issuers who have tried that over the years, and they've always sort of fallen short because of one reason or another, but it would solve a lot of the issues that you highlighted. The money would finally have a place to go on the central bank balance sheet. What outflows banks suffers, they can refinance from the central bank. No more distortions in treasury markets. It would be 100% safe. No bank run risk as of today. If you want to redeem Tether, you don't do it with Tether, but with a crypto exchange. And most crypto exchanges depend on Tether, because without Tether, there's no more arbitrage between them. The economics of this is not worked out. We just don't know whether the design of redemption at stablecoins have the same stability as for banks or mutual funds, right? So why is it that no central bank just gives access to the facilities? In Europe, for example, we already have stablecoin issuers have access to the payment system. Just this last step has never been taken, and I don't understand why.
No, this is certainly under discussion jointly with the other elements that I have mentioned before. In order to have access to the central bank facility, you have to be regulated and have certain kind of characteristics. So this is not in principle ruled out. It is considered in combination with the other parts of the regulation. So let me just say that I don't want to be too negative on stablecoin. So as I did this intervention that was mostly as a policymaker to reflect on the risks of stablecoin, and by also mention en passant that stablecoin also have opportunities, because they have a value in terms of being a native on the blockchain and a good form of digital form of money, in order to be used, programmable money to be used in a smart contract. So what I want to stress is that, I mean, this is personal, no? Is what I see the future. So now we have blockchain, they provide in principle a lot of opportunities. No? We don't see a lot of tangible opportunities because we don't have practical way we use the blockchain for the households and the firms at the moment. These activities are mostly related to the crypto space, to the ecosystem of the crypto space. But in principle, in the future, we could have, I don't know, forms of tokenization for maybe really in the future, for real estate. We don't need a notary, something like this, or a tokenization of debt that is easier, no? So we need a digital form of money that is programmable in a blockchain to have a smart contract. We need this. And stablecoin has emerged as a market. This is the solution that the market has created. As a regulator, what we have to do is money. So they should be regulated as a money, because we cannot do differently. So there are these principles. There is discussion, you know, at the international level. There are forms of regulation that is flourishing. The Genius Act is the first one. But we have to consider that also internationally, being so technology has no borders, no, so you cannot regulate a stablecoin in a country. And of course, US is very important because of 99% of the stablecoin are denominated in US dollar. But regulation should be done in a coordinated way internationally in order to have really a future monetary system that is balanced and simply we really reduce the risk for the consumer and for the society.
I have a question, but first...
Yes, my name is Cyril Ganspan. I'm the director of the Crypto Asset Institute in Paris. I was supposed to be the chair of your session. My question is the following. We've seen with the collapse of Terra Luna that the failure of, in the event of failure, the bankruptcy of a stablecoin could lead to a financial crisis.
Financial?
Crisis. On the other hand, in the event of success, if everyone wants to be paid in stablecoins because they want to access to DeFi, then this could make more difficult the possibility for banks to grant loans. They could reduce bank deposits, and also they could freeze the interbank market, leading to a financial crisis also in case of success. What do you think of this remark?
I mean, yes, these are all elements that have to be considered. So it's a very good point. It's not, I have nothing to add.
I have a question for you, Leonardo. As I understood, wholesale CBDC could be a great competitor for stablecoin, with less risk or no risk at all. And then this is one of the conclusion of the paper of yesterday afternoon. And then what was pointing the author is that the European Central Bank should point to have quickly say CBDC instead of talking about retail CBDC and all the political issues that such retail CBDCs imply. What are the steps now? When do you envision one or more than one wholesale CBDC will appear? And what are the? I think that there are some projects with Bank of International Settlement and some central banks. If you can share with us this project or the future of such a wholesale CBDC.
No, there is a lot of discussion about what will be the future of the monetary system, and I would answer by stressing what are the differences between CBDCs and stablecoin and tokenized deposits. So CBDC are different from stablecoins tokenized deposit because they are a direct form of central bank money. And the difference is institutional, is not only technological. So because CBDC are a direct liability of the central bank, while tokenized deposits are liabilities of a commercial bank, and stablecoins are liability of private issuers. So it's a different institutional characteristic. And central bank money is the ultimate settlement asset. So if I pay someone with the $1, is $1, and that's it. The contract is settled, and it is the anchor of the monetary system. But in order to economically, what is why we need the CBDC? So the CBDC. It is considered, in most jurisdictions, a store of value used for transaction. No, it's a form of payment. It's as cash. No, it is not does not grant interest rates, and it is limited. There is a cap, no? And in some cases, it's not even programmable. So it is, we cannot use CBDC retail in a smart contract. So if really, as I said, is the future if, to have a smart contract. So this is the future. It is not because we need a digital form of money as a store of value, no? Because the stable coin, they are used for both. Store of value in some countries, in some developing countries that have a situation of instability of the currency, of high inflation and so on, but they are also used, and this is the main use into the blockchain as a digital form of money that is programmable and can be used in smart contract. So CBDC, I can see this as an additional option for consumer and firms as a form of payment that is digital, super secure, and so on. Stable coins and tokenized deposits are different, because stable coins and tokenized deposits are a programmable form of money, no? They can use a smart contract and so on. And in the case of tokenized deposit, the settlement into the platform needs CBDC wholesale. So this means that we always maybe have in mind this idea of CBDC retail. But what is very important for the future monetary system are the CBDC wholesale, because these allow for the settlement with the tokenized
And what do you
deposit.
envision the timeline for having these wholesale CBDCs in Europe or wherever?
Just there is I'm not positioned to do something like to discuss about potential scenarios, but of course there is a lot of discussion about this, and the use of this digital form of money are considered. Stablecoin, CBDC, wholesale, together with tokenized deposit, and so on. In my presentation, I have simply alerted on the challenges that we have with the stable coins, and then in the follow-up discussion, I hope that I've elaborated on the fact that why they should be regulated. Now, of course, there are different ways we can have a monetary system in the future. I have also highlighted why I believe personally that tokenized deposit is a very solid way to insert forms of digital money that is programmable, preserving the two-tier system. But in this case, we need CBDC wholesale, because we need the settlement done into the platform via CBDC wholesale.
So thank you for your presentation. Oh, there is another question, sorry.
I do a more basic question. In your opinion, is there a kind of, I don't know, communication risk when institutions talk about CBDC? Because I participate a lot of events talking about this, for example, digital euro, and I listen a lot of times some kind of comparison between this kind of assets and or currency and cryptocurrency. Now, we know that there is not a comparison because they are not the same thing, but for population, so people that don't know both of CBDC and cryptocurrency, which is the risk of this kind of communication from the institution or people talking about that?
I mean, I can see that there is a lot of confusion. So you pointed out really a challenge that central bankers have in order to explain the role of CBDC and the real role, the fact that they are a policy instrument, they are designed for safety, resilience, and trust, and they are different from stablecoin, tokenized deposit, and they are very different with respect to the other form of crypto assets. Sometimes in the discussion, one one could tend to confuse the CBDC is the alternative to Bitcoin. It's a completely different form of digital money. It is not so easy because sometimes it also implies a lot of technical knowledge, and the challenge is to increase also the digital and financial literacy of the population with respect to this new instrument. That is not so easy. No, I agree, it's a challenge.
So I thank you for your presentation, especially for, you see that our two keynote speech yesterday and today pointed out to the risk posed by crypto asset and stable coins. Now we leave the floor to Cyril and another keynote speaker. Then the second part of this conference will tackle the fact that we can also have opportunities combined with stable coins, crypto assets, and CBDCs.
Yes, please welcome Stefano Rossi, Director and Digital Asset Lead at PwC Italia.
Sì, non si ritrovano? Se no non possiamo
Mic is this one? Okay. Sorry for the interruption. I suppose I sent the slide. Anyway, it's a pleasure to be with all of you today. A lot of interesting discussions. I'm sorry, my background is in political sciences, so I'm not into computer science and economics from a mathematical point of view, and I couldn't grasp some of the papers that were presented, but I guess the amount and the level of importance of the data and the proposition I saw in some of the papers were very compelling, and I hope to try to find a way to also use them in the work we do as, at PwC. So today I have the opportunity to speak with you about using a pun from the merge when Ethereum shifted to proof of stake. We're gonna talk about the merge between traditional finance and decentralized finance. I am Stefano Rossi, director in PwC Italy. I lead the blockchain and digital asset team. We are a team of 14 dedicated professionals only on blockchain and digital assets. The main work we're doing right now on blockchain digital assets is around custody. I mean, custody is the paramount when you want to deal with this kind of assets. No keys, no bitcoins. So no keys, no assets. That's the first thing. When you have to deal with blockchain, the paramount thing to have in mind is custody. And of course, from custody and all the different opportunities that arose on the digital asset world, now we have a lot of talks about tokenization. There has already been a lot of discussion around, for example, stablecoins. Stablecoins were born in 2014 with Tether, and so they have come a long way. And they are used in payments, and one of the main areas in which we focus today is also payments, considered in terms of crypto payments. So we're allowing some clients to being paid in cryptos and stable coins. Some of them, they don't want to deal with the underlying assets, so they just want to have the traditional currency they use for the payment. Some others, instead, they want to deal with the underlying assets, with all the different, of course, intricacies of dealing, again, with the custody of the assets. And, of course, a lot of work about DeFi, and we are gonna switch with the focus on DeFi soon. Another main area we are seeing today is digital identity. Probably some of you have heard of EUDI. EUDI is going to be the new digital identity for European citizens starting from 2028. It's going to be a mandate. And so we are trying to understand whether the EUDI wallet could resolve the problem of identifying users, especially in DeFi. Because, of course, anybody can be anyone in the DeFi space. Anyone can transact with anyone without knowing the counterpart. And so for a world where traditional finance need to take something from DeFi, of course, we have to have a regulated environment, and digital identity is a very important part. We also do some work on zero knowledge proof, but I'll keep it for another talk. Why at PwC? I mean, we are, and I thank the colleague from the BIS, we are a very heavily regulated firm. We are both working on the audit side and the consultancy side. I'm on that side. And why it's great to work at PwC is because we have this opportunity to merge also our knowledge with the knowledge of our peers that do work in financial risk, non-financial risk management, tax, accounting, legal, AML, compliance. Because at the end of the day, our clients, when they want to deal with digital assets, they will like to have peace of mind. So let's say they would like to get payments from clients that have Bitcoin, but they want to do this in a compliant way. So we have to give them a compliant provider that can hold the asset, exchange the assets on the market, and then deal with the settlement on their bank account. So really for us, it's important today to talk about these topics because the regulation is catching up, as you would see. I'll explain briefly what the opportunities are coming from what kind of opportunities are arising from the regulation. And of course, the last part, which is very important, we always stress a lot when we have project with clients, is about cybersecurity and privacy. Because I mean, DeFi is a new thing. Bitcoin was born in 2009. This is a very nascent technology opportunity for the world, but still there are a lot of risks to be managed, and therefore we would like to tackle them the same way we tackle in traditional finance. So what are we really talking about in terms of numbers? I love numbers, and so I always try to start from them. I mean, at a first glance, there is no comparison, right? The traditional finance aggregated value today is probably way more than 100 trillion. While DeFi, if you take about the total value locked in DeFi application, like lending, yield farming, whatever, exchanges, it's only 138 billion. This was 2 days ago. I have to update it again because now it's 130. So as always, changes, and we can even keep up with it. But of course, and we had a glance of it before from the BIS. The stablecoin market is huge. I mean, if you take what the capitalization is today compared to the number that moves, if you go on the Visa on-chain analytics dashboard, you see that stablecoin moves a trillion per month. And I mean, not only in the exchange world, because 60% of the use of stablecoin is for the settlement and the netting of the position between exchanges, because of course stablecoins are used for arbitrage between them and to of course match the positions. But also there is a lot of use, as we saw, from emerging markets, which are probably having the lion's share right now. And in terms of protocols, it's nice to see that actually Bitcoin is the third in terms of total value locked in the DeFi space. It accounts for more or less 7 billion. But the two protocols where you see the most in DeFi are of course Ethereum, because Ethereum gave the opportunity to use smart contracts and then create tokens and define application, decentralized application in the digital asset space. And Solana is the first contender. And so these are the two main blockchains where you will see DeFi going on today. But it's true that we're witnessing this merge, because what happens if some of this traditional finance value is slowly pouring into the DeFi world? I mean, even today, with this small amount, the amount of value that is being exchanged thanks to these protocols, it's becoming huge. And I understand it could pose a lot of risk if it's not managed well. But what if the DeFi world meets this multi-trillion legacy TradFi system? What is going to happen? I mean, everything started from, we said Bitcoin, right? So crypto assets, they're unbacked, it's true. Bitcoin is backed by, I would say, energy. Others are backed by proof of stake, because if you have tokens to be put at stake, then you allow the network to go forward. And of course, the crypto assets market is the largest. It's more or less 3 trillion in market cap. Then we have stablecoin. I'm not going to repeat myself because we already had the intro on stablecoins, and that's the second largest capitalized asset, which is basically a money instrument that we have on blockchain. But on the third side, you see there is this small niche that is evolving, which is tokenized securities. And this is where right now our clients are asking the most, because they really want to see what is going to be like a world where you can handle tokenized securities in the form of tokens. Of course, to have tokenized securities being exchanged on blockchain, then you have also to have the cash leg on chain, if you want to have the whole efficiencies that you can think of. But we have a slide for that in a while. So right now, you see a small number just because tokenization is a thing of the last 3-4 years. But you have still a lot of big players playing the game. You have BlackRock, you have Societe Generale, you have Amundi, mainly asset managers, but also corporates that are issuing bonds, tokenized bonds, and trying to see if they can find any efficiencies by using blockchain to finance them on the market. So what is the tokenized securities market today? Today, and of course we all know stablecoins are not securities, but I put them just for a comparison in terms of the amount. So if we take that stablecoins are 316 billion, the tokenized securities market, as we said, is small, and it's mainly formed by tokenized debt. So that's the largest share in terms of securities that we see today. But tomorrow, if a few things are gonna align, and this is the most conservative estimate that we found on the market by McKinsey, because you have the 2 trillion opportunity by 2030 by McKinsey, and you have the largest is by BCG and Ripple, which is around 16. So if we take the most conservative estimate by McKinsey, you're gonna see that the stablecoin market is gonna boom to 1 trillion, more or less. That's the largest block on the left. But it's going to be a huge boost also on the securities side. Mutual funds, ETFs, loans, bonds, with a relative use for alternatives and the tokenization, for example, of commodities like precious metals. Again, we were talking about big players, and I mean, I don't think there is a bigger player in the space of the asset managers like BlackRock. And BlackRock, since 2021, actually started investing heavily in blockchain. In 2022, they started thinking about Beetle. Beetle is the first tokenized on-chain money market fund issued by BlackRock, which is basically a money market fund that has no changing NAV, because it's considered like a stable coin at the end. The NAV is always $1, but it's on-chain, it's issued on several blockchain. I think it's 7 blockchains right now. And it can also be funded and invested in stable coins. So BlackRock for the first time changed the market. So together with Securitize, which is the transfer agent and the issuing company, they were able to get all these features, which are not on paper anymore, but they are actually doable, even on financial, traditional financial markets. Because now they are accessing the DeFi liquidity. Most of the Beetle holders today are blockchain foundations that are using Beetle, of course, to get yield, because Beetle invests in short-term treasury bills. So they get the yield from that. And these companies didn't have to exchange the stable coins they had in the treasury. They just invested them into Beetle. With instant transaction, because if you send a stable coin, the transaction is almost instant. Global reach, because Beetle can be purchased almost anywhere in the world. And of course, we talk already about programmability. The dividends and the yield is put daily on the account holder addresses, and that is programmed into the smart contract token. So what do we see coming in the traditional finance world? If all actors in the value chain are gonna introduce tokenization in their models, we're gonna see improvement in interoperability, automation, distribution. There's gonna be much larger liquidity, because we were saying if traditional finance brings more money into the DeFi world, of course, liquidity is gonna rise. And there is a huge opportunity also to automate operational compliance processes, because you cannot invest in Beetle. I mean, I couldn't invest in Beetle because I'm no institutional investor. So KYC is embedded at the beginning. So you cannot sell Beetle tokens to anyone. So KYC is, I would say, programmed in the token itself. And there's also the possibility for the holders at some point to even directly transfer their assets between each other. But this is something that probably is gonna come if, as I said at the beginning, digital identity is gonna be also tapped into this space. So just to close up with Larry Fink, the CEO and chairman of BlackRock. In 2021, they started investing, and in 2025, he said that we're just at the beginning of the tokenization of all assets, from real estate to equity to bonds across the board. So something is changing, and this merge of traditional finance, decentralized finance will change probably the economic world as we know it, because we are already seeing established banking system trying to innovate with blockchain-based networks. And I would like to open a small parenthesis here on the, I would say, huge amount of work that the ECB is doing on the wholesale CBDC side. I don't know if you are aware, there are these two dual track strategy, which is called Ponte se Appia, because the aim of the ECB is to basically allow the tokenized securities issued on DLT to then tap into the Eurosystem target system to then have the cash leg in the form of a wholesale CBDC. If we get there, we could then have the best of the blockchain world, where you have the programmability of the securities alongside with a cash leg, which is of course compliant and could open up a lot of opportunities for the future. I don't know if you're aware of this dual track strategy by the ECB. They already did an exploratory work, and we had the opportunity to play with to work with a market participant. And I remember when I was in the room and they were closing the settlement of the transaction, I remember the banking operators there saying, it's crazy that in 10 minutes we were able to settle a financial instrument. I mean, for them was really gobsmacking. And just another number, the trading volume happening on decentralized exchange on DeFi is, the average is 13 billion in the last 2 months. So again, you can see it's a small number, but it's a big one for DeFi, because if you think about the total value locked, 30 billion moved every day, it's comparable to mid-tier centralized exchanges. I mean, DeFi is nothing new, apart from the technology. DeFi is the traditional finance world with blockchain and token mechanism inside. Of course, it's something more because of the smart contracts, the programmability, and then it could be the enabler of next generation infrastructure for traditional finance. So, of course, TradFi is already englobating DeFi, if you take BlackRock. And then I really see this convergence phase where legacy institutions and decentralized protocols are co-developing this scalable, compliant financial system. And again, just not to repeat myself about BlackRock, I already spoke about Beetle, but global leaders like JP Morgan, Deutsche Börse, just to name a few, they are actively integrating these DeFi primitives into their business models. And this is a number that scares me a bit, because this is about the derivatives contract called perpetuals. So basically a futures contract that never expires as long as you can take the margin. We have and we see 33 billion of perpetuals trading volume every day happening in DeFi. It's a huge number, and maybe this is one of the, I would say, riskiest part of DeFi, because there you have no rules in a way. If somebody wants to open a perp contract and find a buyer, then the contract is done, because it's all based on smart contracts. So to bring this derivatives demand and this huge leverage, because this can go up to 100x leverage, which is huge, into TradFi, there I can see regulators not very happy about it. So, going to the end, what are the synergies, the benefits, and the challenges of these two words? The synergies come from the paramount achievement of Bitcoin. You have a single source of truth. You have one blockchain, if you use a blockchain, where everyone knows the same amount of data as you know, of course in the form of alphanumeric numbers, but you don't have to rely on third parties to know that a transaction happened. You just go on the block explorer, and if it is a smart contract, you see everything, all the functions. Of course, you get the best part. It's atomic settlement. You have the same, on the same protocol, you not only have the token representing the security, but also the cash leg, and you get this DVP. So you have delivery versus payment. So in the traditional finance world, this means reducing post-trade, and of course, this challenges the T plus X cycles. And then the other synergy is that in DeFi, they call it DeFi Legos, the architecture is composable. You can get something from a specific application and merge it with another, creating a new product or instrument. The larger benefits in a world always going faster and faster are, of course, a faster transaction. It's a market that never sleeps. It's 24/7, 365 days a year. It gives global access to liquidity, and we are seeing this, just to take the last example from Venezuela, we saw a spike in Venezuela buying Tether and USDC after the collapse of the Maduro's regime. And in terms of benefits, when you use blockchain, you actually have transparency and auditability because everything is there, everything is written. You cannot cancel a transaction, you cannot cancel a contract that you have done with somebody. So it stays there on the blockchain. For the challenges, still a lot of regulatory uncertainties, it's true, and regulatory arbitrage because you can do something in one jurisdiction, you cannot do the same thing into another. Cybersecurity vulnerabilities is still probably the largest problem in DeFi because some codes are completely new. And also now with AI, there are bots programmed to find bugs into early, newly released smart contracts. And if these smart contracts are not well written, they could pose several risks to the one that use them. So robust governance mechanism is also important to have in mind. And then again, risk management. I mean, the same that the traditional finance world has done in years, now it's being, it has to be done also in DeFi. Because without risk management, you can have the best smart contract in the world, the best channel of liquidity you can think of, but the moment you have not managed the risk, and one of these risks arise, then it's the end of the of your smart contract. So what are the takeaways from our speech? It's true that DeFi is accelerating. We see rising volumes. Institutions are using DeFi primitives into their business models. But the real impact, we think, is when scalable ready infrastructure are going to be seamlessly integrated into traditional finance ecosystem. So again, DeFi's growth undeniable. Where DeFi goes, it depends on the strength of the building blocks that are being built as we speak. Institutional adoption is accelerating, it's no doubt. But of course, this asks for a robust banking grade DeFi foundations. Again, the more scalable, ready to deploy infrastructure we will see, the more unlocks DeFi real impact. And since momentum is rising, I understand the difficulty for regulators because regulators still have to catch up. Think about that MiCAR doesn't really regulate DeFi in Europe right now. So at some point, DeFi also will have its regulatory moment. So just to close up, to become truly disruptive, DeFi and the DeFi ecosystem have to make themselves known to the traditional finance world, but they have to think in mind that in order to tap into the multi-trillion dollar economy, they have to play in a way by the rules of that economy and integrate the same mechanism that are already present in the traditional finance space. Thank you very much.
Thank you. You've mentioned a couple of benefits of this convergence or of tokenization, among others, 24/7 availability, faster than T+X settlement, exactly, global access to liquidity. Now, I think a lot of we could have many of these things without any form of blockchain. So I think the technology is not the limiting factor. Instead, we've had debates on like optimal trading hours, if you think about stock markets, about settlement cycles for decades, really. I feel like now with DeFi, everybody is kind of saying that we have these benefits, and now finally we can we can implement this. But there are many reasons for why we don't have those. Like traders like to sleep, settlement allows for netting, global access where there's geopolitics at play, and all of that. So what is your take on that?
I mean, I would rather to sleep at night. So I don't like when I go to bed and Bitcoin is, let's say, at 1, and then during the night it goes to 0.5. But yes, this is this new world has started in a different way. So the blockchain never sleeps. There is always transactions being asked by the network, and transactions are going on and on, no stop. I mean, we don't know when blockchain transactions are going to stop. And I mean, I understand the question. I don't actually have a take. I would say I'd rather have a crypto and DeFi world working on this condition in terms of faster transaction and the no sleeping hours time. But maybe on the traditional finance side, I would wait a few more years before having the same characteristics.
Thank you very much. I have a question about this link between decentralized finance and traditional finance. You mentioned that decentralized finance has learned from traditional finance, but now elements of traditional finance are also interacting with the decentralized finance. So far, what are the most promising application of decentralized finance that are useful for consumers or firms? And this is outside the crypto space. That is, decentralized finance, of course, is mostly at the moment auto-referential. That is using ways to maximize crypto portfolios, or is always related to crypto activities. So even in the future, what are the practical applications that decentralized finance could have for households, firms that are in the real world?
Of course, great question. I think I tried to give at least one example already during my speech. I guess if you live in an emerging economy and you rely on money to buy things for your sustainment, and then you have one day your currency is at some level, and then the other day it's completely depreciated. I guess having to access to a global network that allows you to independently trade and use this new form of money to buy things that are important for your household, I think that is really life-changing for some. So I understand why in some emerging economies stable coins are being treated as a preferred form of money, because when you see your currency being going like a roller coaster, and you want to preserve some wealth, let's say, and use this this instrument to in the real life, this is already happening. I don't know the actual figures of this, but still, if I see that 40% of the stable coins is being used in emerging markets, and the majority, to be honest, is being done by cross-border payments. Most of the use is by corporates that want to use an alternative payment system compared to the traditional banking one, because they don't want, either they don't want to wait X days for a settlement, either they don't want to have FX, as you presented before, FX spreads too high. With stablecoin, they settle in dollars, and at the end of the day, for them, they have a faster settlement, and sometimes they also save a lot of fees. So I would say these two main things are already happening today.
Just a follow-up question, because it seems to me that this use of stablecoin that are also documented and so on is mostly deriving from a failure of trust. So I was mostly thinking about what could be the application in a normal situation, that is a situation of a country or a jurisdiction where there is trust in the institution, and therefore household and firms would like to exploit the benefit of the technology in order to, for some activities or services that are self-welfare improving. So let's put on a side and understand the use of stablecoin in a situation where there is high inflation and lack of trust in the institution. But I was mostly referring to situation for us, I mean for also household and firms that live in a world where there is a trust in the institution.
I'll try to explain by going back a bit. I mean, stablecoins were born for the crypto world, and I don't think there is anyone that could say the opposite. The crypto space lacked a fast fiat settlement because, for one reason, banking accounts for exchanges were hardly opened. So exchanges have, for a long time, had basically no access to the traditional banking world, up to, I would say, 3 years ago. Now things are going to be different because of the regulation. And so stablecoins were born for a specific reason. Going today, and given the largest use that we see in stablecoins, I understand why in Europe we still have, even though the regulation allows to have the e-money tokens under MiCA, I understand why we still don't have so many stablecoins euro-denominated, because in Europe we already have good forms of money to be exchanged, being them commercial bank money or other schemes that we can use, for example, Satispay in Italy, just to give an example, Bancomat Pay. So these instruments have a space where there is a problem. But to possibly answer your question, I would say right now they're being seen as an improve, especially for the financial world. So the example of Beetle really tells the story. And we have clients that are asking us, can we do the same as Beetle? Because we want to understand what is the benefits that we can get from a faster settlement, reducing operational costs. So can I allow more and more investors to invest in tokenized securities because I can democratize them? I can use, I can lower the investment required for investing in a fund because these are fractional tokens. So you can decide what is the amount that you're going to be asking for an investment. So there maybe it's going to be the best innovation coming from tokenization in stablecoins. Because again, if you also get the DVP, so I'm selling a security and I also get the money more or less at the same time, you can imagine what kind of efficiencies that this creates for for a world dominated still by T plus X cycles. But today, and this is personal opinion, I don't see much use of stablecoin in economies like ours, where we already have good form of money. So I have my credit card. If I want to pay someone, I pay by credit card. If I want to send money abroad, if it is in euro, I use the SEPA system. So these things work where there's a lack. And those that understand where is the missing link will probably create the new link between traditional finance and DeFi. So I don't know if I replied to the question, but it's a topic still to be discovered. This will unfold before our eyes, I think. Yes.
Thanks a lot, Stefano. I have one question. You mentioned legal arbitrage is possible. And my question would be, do you think that regulators are actively shaping the possibilities of legal arbitrage? Or you could also think about industry codes of conduct or something like that, that are shaping actively arbitrage possibilities? Or do you think that MiCA and other regulations are more, driven by European values and they are inherently shaped by what has been regulated before? Or do you think we see active competition in regulation now to enable legal arbitrage?
This is a very tough question, and this is not really my my domain. But one thing is true. Think about stablecoins. Stablecoins were used even without regulation. And still, think about Tether. Tether decided not to comply with the European laws. So they are not going to issue an EMT because of the reserves. Because most of the business model of Tether is being done by the reserves because they can invest the majority of the assets in the treasury bills. And I understand that in the States, because if these are treasury bills, it's a win-win mechanism. In Europe, it's not the same, because then to have a USD denominated money token that invests the reserve into something else, which goes to fund not something that is in Europe, but something else, of course, needs to be taken into account. So I don't think this is a problem of the crypto space. You have legal arbitrage for so many things. And I don't want to start, I don't want to polemize here, but if you think about the international law, and I was under stress today given some actions being done by the Trump administration, I think, at least if we go back to cryptos, I really think MiCA is a good starting point, because having a level playing field for the whole Europe, it's great. The problem is, if we take Italy, we still haven't seen a single CASP license. We still haven't seen an e-money token being issued in Italy, because Italy decided to take the whole transition period for the 18-month. And this created situations where most of the MiCA licenses are being issued in other countries, which took, let's say, MiCA differently than our country. So in a way, same regulation, different application. So I guess that is inevitable, but I think this is a larger problem for Europe, where this is not only about regulating cryptos, but deciding on, in the same way, on monetary policy, fiscal policy, banking union. So there is a lot of work to be done in the European Union rather than this, if you ask. I don't know if this has answered the question.
All right. Happy to be the last question before coffee, so I'll keep it short. So as you pointed out, stablecoins really, and you could see this in Leonardo's chart as well, where stablecoins really burst onto the scene with DeFi, right? They existed in 2014, but it wasn't until DeFi summer that stablecoins really blew up and became a very important marketplace. And so DeFi, stablecoins are used in the DeFi market because you don't have that institutional support, as you pointed out. But something like Bildl isn't really DeFi, right? It's an institutional blockchain. Like it's not DeFi, ultimately. So they are using blockchains for settlement and institutional lending and institutional trades, which, speed and efficiency. But it's not free entry, right? I can't go and buy a Bildl token. It's on Ethereum, yes, but it's not publicly available. So do you really think of this as TradFi and DeFi meeting, or is it more just TradFi adopting the technical aspects of DeFi and just reusing that instead of, let's say, Excel spreadsheets?
Yeah, nice one. Yeah, probably the latter. And when you saw me saying DeFi started by copying traditional finance, because you can do lending, borrowing, something that you do with a bank, right?
If you only do over-collateralized lending. Sorry, the lending you do in DeFi isn't bank-style lending because you have to be over-collateralized.
I would say in the traditional world that are more similar to Lombard credit, but still, yes, it's Bidl taking DeFi primitives. There is a token, there is a smart contract, there is settlement in stable coins, and applicate that to a traditional regulated environment. That's a money market fund at the end. And if you take the fine print from the Bidl prospectus, if everything happens to the blockchain, the ultimate dispute resolution will be in the books, because there is also a traditional book behind, right? So it's truly on chain, it's being invested into stable coins, and there is a cap to the investment in stable coin. But yes, it's just a traditional finance player taking something from DeFi and bringing it to traditional finance. I mean, we can still take a coffee and discuss with a coffee.
Not to be too late, I think that 10 past 12, we can return here for our panelists, okay?
sorriso quando mi era di approvazione il solito oppure adesso le banche cioè gli stablecoin sicuramente sono regolati male perché erano regolati meglio cioè
e quindi hanno poi dopo visto come si comportavano successivamente nella... prenderci un caffè, se no poi non torniamo. Let's move to the coffee, so otherwise we won't start on time.
e chi sorride no
May I ask the speakers to come to the front in the meantime as the room resets itself? Please, Nicolò, Miko, and Dovil. Thank you. You press it. This one. Okay. Thank you. Thank you all for being back from a well-deserved coffee break. So thank you for making it back more or less on time. Now, we open now the second part, if you wish, of this second day of the conference, which focuses on the industry and like academia connection, looking more on the industry practice. Now, what we're going to do next is a panel focusing on the TradFi and DeFi merger. And we have here, amongst our speakers for today, practitioners, such as those I'm going to introduce in a second. And the panel is going to be split into two. We're going to do a first part with Niccolò Bardoscia from Intesa Sanpaolo, Head of Digital Asset Trading, Miko Curatolo, from Banca Sella, head of the DLT Digital Asset Competence Center, and finally, definitely last but not least, Dovil Silenskite from Wisdom Tree, Director of Digital Asset Research. So, what we're going to focus on this first panel, and we're going to draw a leitmotif that's going to continue also in the second part, is to try to see how DeFi, starting from something relatively fringe at the beginning, now becoming mainstream, is affecting how traditional financial companies are looking at this and what and where the market is going. In the second part of the panel, we'll continue this leitmotif, involving our second part of the speakers, Andrea Filtri from Mediobanca, which I'm going to introduce later, Giulio Rattone from Fabric, and Luca Fantacci as well from the University of Milano. And we're going to try to do a bit of the reverse, looking more on the like history and looking at how we can look at DeFi in those lights and what it means for the market as a whole. Now, on that note, then, if the speakers agree, I would like to get into the discussion. One, in terms of logistics, if you have questions, please feel free to raise your hand, but we'll try to collect the questions and then ask them at the end of the panel. If you really have a burning question, by all means, let us know somehow, and we'll try to make it such as interactive. But we want this to be a conversation, so please, we're here also for you. Now, if we start on the merger theme, then the first question that comes to mind is to start from having a broad view of where the market is. So perhaps I would qualify that as what is the state of the current crypto market, and where does a traditional financial institution could look at to drive inspiration? What I would like to get out is if you have any particular product you see is very relevant for traditional financial companies, we can start from there. So I'll hand over first to Dovil, as we have representation from buy side and sell side today. So I'll start from buy side. So over to you, Dovil.
Thank you very much, and hopefully I did it okay with the microphone. Very happy to be here, and great to see interest in this space. My role is digital asset research, and what this means is I look at the top cryptocurrencies, and I see why investors may want to have them within their multi-asset portfolios. And I spend a lot of time traveling all across Europe, educating them about what is the point of having Bitcoin in a portfolio and what is the point of looking outside Bitcoin. So this is the state that we are all at. In traditional multi-asset investors are starting to see the value of having small crypto allocation within their portfolios, and they're starting to assess what is the best exposure to have within their portfolios. And of course, most of them start with Bitcoin because that is the name that most people recognize, and that is the name that has been running successfully for over 15 years, and that has more than 50% of the total crypto market cap. But Bitcoin is store of value, and when they want growth for their portfolios, they say, what else is there? And there are tens of thousands of tokens. Most of them have no value. Most of them should not be touched by anybody. And they're trying to distill what are the tokens and how do I identify what else is appropriate to be in my portfolio alongside Bitcoin. So I spend a lot of time educating. And I think the good state of the market is that people are showing interest. People recognize that they can no longer ignore crypto because crypto represents over 1% of the total market cap universe. So they want to allocate, and they're trying to decide what is the best way to do that.
Thank you, Dovil. And I think that paints quite an interesting picture, because what I read from that is that there is a growing demand coming from the market in integrating these assets into their portfolios, which is one of the drivers of the merger. Now, I would like to ask the question again on the other side of the pond, to Niccolò and Miko, looking at, I mean, again, if you look at the state of play right now, and in particular, starting from Niccolò, Bitcoin is always mentioned as the key driver for this ecosystem because it's also the most widely known, to your point, Dovil. What is its role, in your view, and in the wider state of the market? Over to you, Niccolò.
So, thanks everyone. So I'm Niccolò Bardoscia. I'm head of digital assets trading and investments at Intesa Sanpaolo. So I oversee the team managing the digital asset portfolios of Intesa. So we have the mandate to invest in Bitcoin, in crypto, as well as crypto-related companies. And this is a prop trading desk. So we don't engage with clients, but invest the bank's money. Coming back to your question, so Bitcoin definitely has, is the most important crypto asset by market cap, and is very different from every other crypto asset. I see Bitcoin as a digital commodity, as, there is no issuer of Bitcoin. Bitcoin is effectively mined, can be mined by anyone around the world, the same way gold or other commodities are mined or created. But contrary to every other commodity, is a digital commodity. And this makes it very different. There is no physicality to it, but also there are advantages. You can send it anywhere in the world very cheaply. You can store it very cheaply. So it's definitely very peculiar. Now, the main characteristic from an economic standpoint of Bitcoin is its scarcity. So there is, of course, there are only 21 million Bitcoin that will ever be created. And this makes it interesting because it's the only commodity where you cannot just make more of if the price goes up. So any other commodity, like people can create more or mine more when the price goes up. There is an incentive to do so. But with Bitcoin, if the price goes up, everybody tries to mine more Bitcoin, but it just gets harder to mine more Bitcoin. There is a mechanism called difficulty adjustment that makes it harder to extract new Bitcoin if more people try to mine. So effectively, there is no supply elasticity to price. This makes it economically interesting, and this makes it a good candidate for a store of value. Now, many people call Bitcoin digital gold. I think it's not necessarily true in the sense that it is trying to become digital gold. But of course, gold has not just these qualities of scarcity, of transferability, fungibility that Bitcoin has. Gold also has thousands of years of history as a good store of value, and Bitcoin doesn't really have that. So I think it's a bit early to call Bitcoin a digital gold, but I think it's also the only digital asset that is a candidate to take that role. And I think we do need a digital gold over time. So this is why Bitcoin is different from other crypto assets. Now, other crypto assets do have value. I mean, of course, a lot of them don't have intrinsic value, but a lot of them also do have value. So, for example, blockchains generate fees from people utilizing smart contracts or moving stable coins around. So there is real revenue being generated by blockchains and paid to stakers. So tokens like Ethereum, Solana, and so on, these have real revenues getting paid to token holders via staking. And so the same way as traditional assets, equities, you can do discounted cash flow analysis and understand, am I happy or not buying this digital asset for this price today or not? So yeah, this is how Bitcoin is different from other crypto assets.
And maybe Dovil, if you want to come back.
I just want to add that, for example, he mentioned Ethereum and Solana. And for investors, I always highlight that Ethereum and Solana also generate yield that they can capture if they engage in staking, which is the governance of the blockchain. And that is quite a distinct feature from Bitcoin. Because Bitcoin, you only get income from a Bitcoin price going up, and you can sell it off. And for Ethereum and Solana, you can earn 3-5% subject to which one you invest into per year, just for participating in the consensus mechanism of that blockchain. So for investors, I always say that it's very, very important to understand the tokenomics of the blockchain they're touching or they're investing in, because there are many differences between different players in the market.
Thank you, Dovil. I would like to come back to that for a second, but I would like to give the opportunity to Miko to actually answer with his view of the state of play with respect to the market.
Thank you. First of all, thank you for the invitation. Very happy to be here again. We were having kind of a similar conversation last year, so happy to provide an update on that. Just to frame, representing a private-owned bank active in the digital asset space since a few years. We are mainly digging into custody and stable coins as initial steps of our strategy. And we were last year discussing on the picture of the market, no? I think what we were discussing is actually happening, no? So we have a regulation. Regulation led to more clarity. Clarity led to more awareness. And awareness is now slowly get us to adoption. It is like saying that it took us 15 years to understand exactly how the technology worked, and now we are trying to adapt it to our organizations. So I think we still miss something, no? And I have to complain about the fact that fast forward 1 year after, still we don't have any CASP license gave to any players in Italy. And this is starting to be a problem, I believe, because the level playing field, no? Given the fact that a foreign player can enter our market with a license got elsewhere, it is something that needs to urge as a topic to be covered by industrial players. Apart from it, and apart from the, let's say, the fact that the industry doesn't go at the same pace of technology innovation, I would say that the market is growing, and we might get to a different pace if many more institutional players step in.
Thank you, Miko. There are two interesting points there that I'd like to both pick up. One is about the hurdles of adoption, but I'll park it for now. There's one thing I wanted to focus on to begin with, which is, you mentioned very neatly that regulation led to clarity, led to awareness. The question I'd like to ask is, how do we translate that demand into real business opportunities for each of the players at the table? Specifically, we see many products which technically do not exist in the traditional financial space. One, the first that comes to mind is like flash loans, that's to cite one. Do you think that those are drivers for the demand we see, the interest into these products? And equally, is there any risk from a bank's point of view in terms of touching these assets? So I'll start with Miko, and then we'll work our way backwards.
So I think compliance is the cost of adoption right now, let's say. So we are now experiencing the fact that the technology proved to be a 24/7 non-stop, let's say, stack, but banks are not. Banks have time windows, no? And so the operational barriers right now is let's say, not related to the single use case, but to the capability of organization to deal with 24/7 activities. And we are still not there yet. So being in the shoes of a bank and of a regulator, no, I would first of all take care of the fact that you can get to a fully operable 24/7 activities with compliance in, and then we will dig into use cases, let's say.
Do you agree?
Yeah, so I think like over the past couple of years, we're starting to see see banks and financial institutions engage more and more with digital assets. And it's not, I mean, there are two different ways that this is happening. On one side, digital assets are being wrapped into traditional products like ETFs. So the most successful product that a financial institution launched in crypto was the Bitcoin Spot ETF by BlackRock. And that's an ETF. It's not technologically different from any other ETF. So it doesn't pose any challenge for the buyers, the traders of these products. And the other stream is the opposite. It is tokenization. Tokenization means taking a traditional asset and putting it into a TradFi, so taking a traditional asset and put it into a digital token. So tokenization and ETFs are effectively one the opposite of the other, and both things are happening at the same time. So traditional products are being launched to get exposure to Bitcoin, and digital tokens like the BIDL funds are taking money market funds and equities and bonds on chain. And these two things are happening at the same time. They're both being successful, and they're both slowly starting to emerge. And these are both ways that banks can start engaging with digital assets. So on one side is the more crypto side, and the other side is the tokenization of traditional assets, which has the core benefits to bring these traditional assets to a new audience. If we look at the BIDL money market fund, for example, all the buyers of this BIDL money market fund are actually digital native companies. They are stablecoin issuers. There are no traditional clients buying BIDL, buying a money market fund on chain. So when you issue tokenized securities, probably the first buyers are the crypto native companies, the crypto native people, because tokenization brings a traditional asset to a technology that they are already using.
Deauville, I wanted to, building on what Nicolas mentioned, you probably have, of all of us, the best view of what the market is thinking. Do you agree with, do you concur with his view? Is there any more traditional player getting into the market, looking at the more innovative products? Is there a separation between what people are used to touch and therefore giving preference to regulated products as opposed to the more frontier ones? What's your take?
My take is very broad because we as Wisdom Tree in Europe, we have issued 12 crypto exchange traded products. 8 of them are single coin, 4 of them are crypto baskets. So in Europe, we're taking the new technology, which is crypto, and putting it into the wrapper that investors recognize and that investors feel comfortable with. In the US, we're issuing tokenized funds. So there, we are taking the existing exposures that people are comfortable with and putting in a new wrapper. But what I like about what's happening in Europe is crypto is 24/7 world. Crypto is the market that reacts when a geopolitical crisis explodes Friday evening or over the weekend. People can't trade anything else, so they trade crypto, and crypto can spike up or spike down. And I always say to every single investor I talk to, please do not ever panic buy or panic sell anything. Something is happening, walk away. Because you have run the analysis, you have decided how much of this exposure you want within your portfolio, you decided on rebalance frequency or signals to implement rebalance, stick to that. Because if you panic buy or panic sell, you will end up losing money. And I think having crypto within ETP wrappers gives some protection to investors because they are only able to trade when European exchanges are open. And European exchanges, back to the point that you were making, they are operating during normal working hours. So if something is happening on Saturday, that investor can't get rid of or obtain exposure to crypto ETP. He or she has to wait until Monday morning until the exchange is open. And by that time, many more news may come out and they may change their views.
Thank you, Dovil. I just wanted to ask a follow-up more on the probably Miko side, and Nicola, maybe you have also your view. But I think what you said, like 24/7 markets, etc., lies at the center of the barrier to adoption, because at least from where I sit, because often markets can go much faster than the operations within a traditional bank. Do you think, Miko, that there's going to be a challenge in the coming years in order to leverage the best that this new native nascent digital capital market ecosystem has to offer? And is that an opportunity for essentially new revenue lines for different institutions if they play this opportunity well?
I'll answer you in a tweet. Yes, it is. Yes, it is. The point is, so amazingly enough, banks are not exactly the fastest animal in the jungle. So it will take years. And for sure, you'll get to identify new revenue streams. The point is the cost of the organization you're setting up, no? So obviously you might get to find a balance. And I think this exploration will take time and will be progressive, no? So we'll start from maybe the settlement side of or the payment side that are more knowledgeable to a bank. And then you will slightly move to brand new use cases adopted from the crypto world.
What I hear from that is wire your system with things you know, and then explore above and beyond what you can do today. Would you agree with that, Niccolò?
Yeah. So I think actually there are a lot of challenges for, let's say, a bank to enter the digital asset market. It took us 2 years to do our first Bitcoin trade. So we started in 2022 and we finished in 2024 because it means updating all of the systems related to trading for the bank. It means creating new plumbing. It means understanding the compliance side, the legal, the fiscal framework. It means like understanding a new technology, interfacing new actors, because you don't just buy Bitcoin on a traditional exchange where you're used to buy equities or bonds. So there are a lot of different pieces you need to put together to make it work. But once it's done, then you start having the infrastructure to trade tokenized securities, for example, or other digital assets. And this is very important for a bank, because I think we're going towards a future where more and more assets are being tokenized. And if I think about markets in 10, 15 years, then potentially a vast majority of worldwide assets will be represented by tokens. So it's very important for all financial intermediaries to do this work now to get ready for trading tokens, which not just represent crypto, but potentially equities, bonds, real estate, credit, and so on. And also, I would add, it's very important for banks to build networks with other banks and other financial actors and corporates, because right now there is a lack of standardization, especially in tokenization. Like every digital bond that was issued maybe uses a slightly different blockchain or slightly different standard, or the settlement is different. So we need definitely a lot more standardization on that front, so that banks, companies can start building together an infrastructure and a system to trade digital tokens, which I believe is very important for Europe. Not just for the efficiency of the financial system, but also to make European assets accessible outside of Europe, which is something that tokenization can bring in a capital markets union direction.
Thank you, Niccolò. Now, we talked a lot about assets. Somebody has touched, Miko, in fact, has touched upon, all right, we need also to start from things that are more easier to perhaps touch upon internally with financial institutions. So we talked about tokenization, we talked about capital markets activity. The question I have is, in the conversations in the conference so far, there has been a word that has come up a lot, as you can imagine, and has been everywhere, certainly in 2025, which is how do we actually pay for all these things? So this is where stable coins come into play and other forms of money. Now, the first question I have is, Dovil, from your point of view, what do you think about stablecoin as a way to facilitate activity between clients and customers at a capital markets level?
I think stablecoins are a brilliant invention for people who want to trade, for example, tokenized securities. Because the key difficulty in the world is moving from fiat to on-chain. And stablecoins is a good bridge. So once a person moves and has stablecoin wallet, then it becomes much, much easier to trade the new instruments that are being issued. And you get the exposures that he or she wants to get exposure to. But otherwise, I see more use for stablecoins in emerging market countries, where people get paid, and they know that their paycheck will soon lose value because of extreme inflation. So for them to be able to switch to stablecoin and protect the purchasing power, because that stablecoin is backed by US dollar or euro or Swiss franc or any other currency that it may be, it's a very good option.
Thank you. And Niccolò, from a bank's point of view, would you agree?
Yeah, so stablecoins were born, as was said earlier by Stefano in the previous panel, as a way to settle trades for high-frequency traders who wanted to move money between crypto exchanges about 10 years ago. Then they started being adopted, as you were saying, Dovil, in emerging markets as a way to preserve wealth effectively. So for companies and people to have dollars, and they brought access to the dollar for people who didn't have access to the dollar. So people were not interested about the token, they were interested about the underlying asset, which was the dollar. And this is what pushed stable coins in emerging markets. And right now, actually, a big driver of stablecoin adoption is smart contracts. So a lot of stablecoins are not being held by people, they're being held by programs. And this is what's happening in DeFi. So stablecoins are being used as collateral to trade perps, for example. They're being used for loans. There are a lot of different uses for stablecoins in DeFi. And if you look at Circle USDC, for example, about 10% of USDC is locked into smart contracts. There is actually a great report on this by Gauntlet, looking at the state of USDC. And people hold stablecoins for yield as well. because, of course, regulated stablecoins in the US and Europe cannot earn yield directly from the issuer, but in practice, a lot of people can earn yield on their stablecoins, either holding them on a centralized exchange, which pays some yield to their stablecoin holders on the platform, or by using them in DeFi, lending stablecoins out to people who want loans. So yield is one of the reasons why stablecoins are getting adopted much more recently, and smart contracts are one of the large holders of stablecoins. And if we look at the near future, maybe stablecoins will also be used by more and more by AI agents who want to do payments or trading because they're easily programmable. So there is definitely an angle there as well, even if it's, of course, still very early. From a bank's perspective, of course, we've seen some banks starting to enter the stablecoin space, both in the US and in Europe. There are different models being chosen by different banks. Some banks issue their own stablecoins, some banks join a consortium, some other banks distribute maybe third-party stablecoins. So there are many different approaches, and there are many different businesses which can be built around stablecoins, not just issuing a stablecoin, but distribution is a big business. For example, exchanges make a lot of money by distributing stablecoins to their users. And also loans are another business angle. So like some companies start asking for loans in stablecoins, and that's another angle that some banks are starting to explore.
There is an underlying question on risks there, but I'll park it for now because we want to cover that in the second panel. I want to take a view from Miko on the same matter before to wrap up the first part of the panel.
So obviously, it is not a secret what we are doing in stablecoins. So together with the 10 of the major European banks, we launched the NewCo that is aimed to bring to the market euro-denominated stablecoins. And we do it because we believe, it was already said, this is a $99.5 dollar-denominated industry, and therefore we deserve euro-denominated to cope with the same vision digital euro has, no? To protect strategically Europe. I don't feel stablecoins are about yield anymore. I feel they're about providing an additional rail to obviously an already super competitive landscape of payments if the focus is Europe. But Europe has a lot to deal with emerging markets, with cross-border activities, with a better settlement of securities once securities get to be tokenized. And for all these reasons, we believe that banks should partner and also deal closely with regulators to better understand how to bring to the market an additional rail. We are getting again back to the previous point. No, there's a 24/7 money tech stack working, but there's no 24/7 banks working. No, so the next challenge will be to merge these two models into a truly effective compliance by design banking system that is also capable to deal with this additional rail.
Thank you, Miko. Just flash question to close the first part is, what would be the ideal crypto outcome for 2026 for each and every one of you? Starting from Miko.
So obviously Kivalis being the most successful Euro-pegged stablecoin in the market, with banks distributing it and building value-added services on it. From a seller perspective, obviously the Volano and network effect that this might get to our custody is super important. Many more banking players with CASP license in Italy and in Europe is mandatory, I believe, because everybody perceives that the regulation might get to a better state, a better definition than it is right now, but we need market players to work with regulators to refine it. If nobody is working on it, if nobody has a license, nobody can tell where the issues are. So I would bet for 2028, let's say, to see many more players in. And why I'm skipping 2027? Because we have been in the process since 3 years, and we are not there yet. So reality is, it is not something you do overnight with your organization. Starting right now to seek for a MiCAR license would probably lead you to have it in 2 years. So I think we are lagging a bit behind, honestly.
A lot of meat on the fire and a request for a network effect. Over to you, Nicolo.
Yeah, I very much agree with you. It's, I mean, the world is changing very fast, and some crypto native players are getting licenses to effectively bring these products in a regulated way to the masses. Crypto natives already have the technology. And if they also get, of course, the regulatory side, which a lot of them are working towards, they can be very, very successful in bringing these products to the market. So, I mean, of course, today we trade bonds on traditional exchanges, we trade crypto on crypto exchanges. But in the world of tomorrow, are we going to trade bonds on crypto exchanges? Because this might actually happen. Like if Coinbase, Kraken, like these crypto exchanges start engaging with tokenized equities, and some of them are tokenized bonds, they might actually get to tokenizing everything more quickly than traditional players are. So I think that all of this is there is an opportunity for banks and traditional players to use this technology to work together with the crypto industry and together with other regulated players, banks, companies, as well as together with the regulator to offer better products, faster, cheaper, safer products to their clients. But also there is a risk. So if the industry doesn't move quickly enough, then we might see actually, we might be in a state where the crypto natives alone take a large majority of the business of more traditional players over the medium term. And this is a very important issue for banks, and regulators and banks should work together to ensure that this technology is being used to actually build better product, and we can get there quickly enough to still be relevant and achieve this.
Thank you, Nicolo, and I would hold that thought for the second part of the panel because that's where we'll start. But Deauville?
I have a very simple vision. So if all of you have investment accounts now, and if you invest in equities, I'm sure that you have equity index fund or equity fund. Some you have diversified exposure to equities. If you have fixed income exposure, you have a basket of bonds. I do hope that most investors will start recognizing over the coming year, couple of years, that trying to identify individual cryptocurrency to invest in is nearly impossible task unless all that person does my job, which is to research cryptocurrencies. So I do hope that most investors will start investing into crypto baskets, because that will give them an opportunity to participate in crypto market and to benefit from its growth without needing to identify individual cryptocurrencies that will be successful over the coming 3, 5, 10 years. So yeah, hopefully this is something that people will start recognizing in the near future.
Thank you, Deauville, and thank you all the speakers. I think that concludes neatly the first part of the panel, so if we can have a round of applause for all the three speakers. Thank you. You're hereby relieved from the duty. So we're gonna swap speakers now. We start the second part of the panel. So thank you again, Nicolo, Miko, and Deauville. And we call in three illustrious speakers as well: Andrea Filtri from Mediobanca, Giulio Rattone from Fabric, and Luca Fantacci from the University of Milan. Again, please, a round of applause for the new speakers. Thank you. Now, I'll let you, as you start talking, please introduce briefly yourself. I'll do a brief intro for Andrea Filtri, Managing Director, Head of Mediobanca Research, Giulio Rattone from Fabric, Chief Operating Officer, and Luca Fantacci, Professor of Economic History at the University of Milan. Now, we left the first part of the panel thinking about all the opportunities, all the the potential that the market may bring, and we left it with a question. Effectively, was lingering in the air, which is, what is the role for banks? We have people looking at economic history, we have people that are interested in general market structures, and people that are actually building that future end state. So I would like to open the second part of the panel with an open-ended question. What is the future for traditional intermediaries, and specifically for banks? So I'll start from Luca, so over to you.
Thank you.
Need to press this one.
This one, there you go. Thank you. I thought you were going to start with the bankers, but having started with the historian, let me make this remark. I believe that since we're discussing more generally the convergence between traditional finance and DeFi, I think that one misapprehension is the idea that DeFi has hit traditional finance from the outside as if it were an exogenous shock coming from technological innovation. And if we represent it this way, we tend to forget that, in fact, it is more appropriately framed as an endogenous evolution coming from within, from the failures of traditional finance. Not by chance, Bitcoin was invented in the midst of the global financial crisis, and as a response to the shortcomings of the traditional banking system and of central banks in their role in regulating and supervising and buffering the traditional financial system. So in fact, I would say from the very beginning, DeFi was a challenge to which the banking system was asked to answer in its own interest, in the interest of finding more stability. So clearly, as initially it was more a provocation, clearly Bitcoin was far removed, we have gotten much closer to the core business of banks with the stable coins and with the response coming from central banks themselves in the form of central bank digital currencies. So I believe these are the main challenges that banks are facing in their core business of managing the payment system and delivering stability to the monetary and financial system. And here I think that the responses are at various levels. One has to do, but I'm sure we will be discussing this at length, with the peculiar shape that the central bank digital currencies take, if they ever see the light in any significant scale, and how banks manage to answer to the peculiar needs that stable coins offer, and that were mentioned even in the previous round of this panel. Particularly, I'm thinking of cross-border payments, because that's where they have been particularly bad at providing viable solutions for the users.
Thank you, Luca. Maybe we'll tilt the question to Andrea, given your position as a head of research at Mediobanca.
Yes, thank you for the invitation. I'm heading both equity and credit research at Mediobanca, and we started our sort of venture of looking at digital assets and digital currencies during the pandemic. It's a big crisis when you work on banks. Big crises are a fact of life, quite a regular event, and they always give the opportunity to learn something new. So we decided to go on digital currency, probably never would we have thought that it would be so rewarding in terms of activity and such a proliferating work. I partly agree with what has been said. The birth of these new products partly has to do with inefficiencies in the status quo, and more to do with the failure of the incumbent payment system. That is expensive, that it is cumbersome, it's surpassed, and clearly the arrival of the new technology can solve a lot of those issues, and banks can probably be pointed at for not having been on the front foot and just being milking the cow of an old system that works well for them. That's only part of the story. The other part being what was being highlighted before by Deauville and the need to find new diversification of assets in portfolios, and so sort of a store of value. And that doesn't have to do much with banks. Now, the moment, I think, that is very important, looking at history of why things emerged then, has got to do with trust and the fact that the great financial crisis dented very much the trust in the solidity of the financial system and hurt the banks with that. So I agree with that aspect for sure. But now we are in the phase, first it was a sort of kindergarten, I'm going to say, mess with all the kids running around and shouting in the proliferation of crypto and stable coins, and it wasn't clear, and then there was this big proliferation, a sort of boom and bust going through FTX, and then a new phase, sort of Phoenix recreation with more order that had to go, in our view, through regulation and sort of borrowing the trust and becoming mainstream, which is what the prior panel has been talking about, the kind of crossing between tokenization on one side and bringing on exchange through sort of established regulated wrappers like ETFs of the new assets and the new technologies. And we're now having to find the balance. If you're the regulator, you're concerned about being sure that you're not throwing the baby with the bathwater, of not breaking what you've got and what works and actually implementing it. And we're of the view that there is space for everyone. Clearly, it's not harmless. And the sort of picture we have depicted is the Bancosaurus looking at away from the asteroid and just lobbying, to stop it, and that's not going to work. So there is a requirement, a sort of requirement of evolution in the banking system and in the banks to understand the new technologies. I think Miko referred to that before. It's going to take some time. It's taking some time. Embed what they can do and try to react in a competitive market way to the challenges, and most of all on the liquidity front, which is what the banks are most concerned about. And I think what they're overlooking is the hit they could get to the top line on the fee income side.
Thank you, Andrea. I really want to go to Giulio, but before, I have a follow-up for Andrea, given what you mentioned. You mentioned very neatly the failure of payment systems. Now, what we hear often, and we heard it in the earlier panel too, is that we need standards, we need programmability. Is that the failure of the current payment system, you think? Is there more? What is the driver, in your view, of the demand? Because what I'd like to ask then Giulio is, okay, how do we make it happen? But before doing that, what is the main failure?
No, I think it's a fair question, and we have to be very careful not to dive too much into the technicalities because we risk missing the wood from the trees. And I think this week has been a fantastic week to flag the risk of just missing the bigger picture, where geopolitics and strategic independence plays a big role. And so if we just focus on whether the current payment system is efficient enough, too costly, too slow, and so on, not 24/7, et cetera, is one aspect. The other is, are geopolitical areas self-standing and independent in making sure their economies can function without somebody else just pushing a button and blocking their economies and their payments. So these two aspects have to go together, and I think this just brings into the picture for Europe the whole story about digital euro and so on.
Thank you, Andrea. Thank you, Andrea. Now that we have set the scene about the history, where we're going, we had a view. The question I have for you, Giulio, is that you're probably the closest to the operationalization of all these new digital capital markets. So the question very openly that I'd like to ask you is, how do we make it happen? We heard Miko earlier talking about, and Nicolas as well, Deauville from the demand of the customers. All the ingredients are there, but what would you think, in your view, are the top priorities that one should look at in order to make it real?
Okay, thank you for having me here. Before all, I'm not a crypto guy. I want to anticipate this. I work in Fabric that has been chosen by SEB in order to develop the digital euro app. So my first response is, we as Fabric, we will work, collaborating with Banca Sella to make it real, for a new stable coin, but we will collaborate even with SEB to put in place the digital euro. And I think that we need a premise here, because on the press and even in the discussion, many people said, okay, we have a sort of stablecoin initiative versus digital euro. And I think that this is completely false. We have completely a different match, a completely different league, and there are completely different needs. We know that stablecoin, that has been said in the previous panel, but stablecoin now have been succeeded because they are being used by the exchange as the conjunction currency between the cryptocurrency and the fiat money. And even because it's a very important factor of protection from the inflation in some countries. If you live in Argentina, if you live in East Africa, you need, the underlying value. Maybe Nicolas mentioned it in the panel before. You need the underlying value because they are interested to buy dollars, but they can't, and so they go to the stable coin. And it's a very interesting business because you're basically a bank and you don't need to pay interest, and so you can do a lot of money on it. Digital euro aim at completely different goals, because digital euro have two main goals that are the monetary anchor, and they want to be an independent payment system. Why the monetary anchor? Because, before all, it's not a deposit, it's not done for the deposit, it's not a reserve of money for anyone, because we will have holding limits. So it's basically used only to pay, and designed only to pay. And the monetary anchor, because I don't know if you know the effect in Sweden. In Sweden, happened that many merchants does not accept cash anymore. So if you analyze, because someone in politics say, okay, this is to remove cash, this is to trace the operation, but it's not that. It's completely the opposite. If you analyze the money in terms of liability, you have three kinds of money in this moment. One is the central bank money, that is the cash, and in the future, if they will be adopted, okay, the central digital money, okay, CDBC. Then you have the private money, that is money issued by the bank. When you pay with your card and you have a wallet, you have commercial banking money. And then you have the crypto asset. And one is liability of ECB. The second is liability of the private bank. The third is not a liability. It's a liability of anyone. So to have the anchor money is because the central bank said, okay, in a world where naturally all the payments are going digital, we need to maintain the anchor money. But more important is the strategic independence of the payment system. Because we know perfectly that we have not a pan-European payment system. If we analyze the European payment system, we know that the users are super served, well served. There are a lot of offers. You can pay in many, many ways, but if you are an Italian citizen and you go in Finland and you go in Germany, you need to have a MasterCard or a Visa card in your pocket. That's for sure, because it's the real only pan-European system. And so the second reason for the digital euro is basically the strategic independence, so to have a payment schema that is independent. And that's all. That's what we will do. So, I mean, I want to clarify that we are talking about completely different, needs, aim, and so on and so forth. As a fabric, we are helping, ECB to develop these. And we want to be a sort of reference point to help the merchant and the banks to do it. Because the time is a little bit long, because the two magic words are legal tender. So digital euro will have legal tender. So it will be mandatory for the banks to issue digital euro, and will be mandatory for all the merchants in Europe to accept. So the time is a little bit long, because we are talking about 2030, to go live in production, really, because it's the date where the legal tender will be in place. But in the next 2 years, we will develop the first pilots. And then there will be a phase when we will help the industry. Imagine all the POS, imagine all the merchant, imagine all the banks, the investment that they have to do in order to jump in the digital euro. That's for, the view. And in terms of the banking system for the digital euro will be mandatory, but for the crypto asset, they are already in my view. There is no something external. It's no more a competition, because if for example, it was very interesting Nicolas, what Nicolas said. I'm very curious if the performances or its trading desk compared with derivatives on other functions, which is different in the risk policies that we have. But we know perfectly that banks are already in the digital asset, in the cryptocurrency world. There is a competition, probably yes, but I think that with the regulation, there are all entities that work on the same field, and that's my vision.
Thank you. I mean, what we see effectively, the picture that is being created is of a nascent ecosystem. Now, the reason, Luca, which I think I wanted to start from the historical point of view, is because personally, I think we can learn a lot from the past, adapting those lessons to the world of today. Everyone talks about risks, typically, and we talked about liquidity risks. We have stablecoin, different forms of money. What type of risk do they encounter? You see credit risk, you see liquidity risk, you see operational risk. Look, the question I have for you is, do you see some parallelism with what happened earlier in history, the history of money and the financialization of the financial system growth over the years, over centuries perhaps, with what's happening here? Because if we look back at the beginning of the 20th century in the US, we had different forms of money which looked similarly, you could argue, to different forms of tokenized deposits. Are we just rehashing a similar history on a different technology? And what will be here something to consider in order not to make potentially the same mistakes?
Short answer, I hope not. But to make the point clear, I do see plenty of similarities with previous innovations. I see similarities, but they have already been highlighted extensively. I mean, between the implications, for example, of stablecoins with other instruments, with different technologies that had similar characteristics. But where I think history can be useful is not in drawing comparisons, because as someone said, I mean, the only lesson that history teaches is that we never learn its lessons, right? So if you spend your time drawing these comparisons, it's a bit discouraging because, you know, it gives you the feeling that you have this compulsion of repetition. What is more interesting is not to seek analogies, but to try and trace a genealogy, if I may, right? To see where we're coming from and where we're heading. And there we have a huge task in front of us, which is finally, thanks to these innovations, thanks to the plurality of different initiatives that are taking place, to establish a sound monetary and financial system, which we are still lacking. Because when I was referring before to the shortcomings of the status quo, I was not talking about, you know, marginal aspects. I was talking about the fact that this as it was called before by Leonardo Gambacorta, the two-tiered system, right? I was very sympathetic with your criticisms of the stablecoins. Where I am more skeptical is in thinking that we should defend the two-tiered system in all its aspects. Of course, it has huge advantages, and we should not throw away the baby with the bathwater, but there are some obvious shortcomings, right, that have to do with the increasing role that central banks have played over the past years to bail out the private banking system, flooding it with liquidity whenever it was required. And so this is where these innovations, I think, can come into the picture to adopt a perspective of complementarity. I'm very sympathetic with what Giulio was saying before. We don't necessarily have to oppose stablecoins and CBDCs, public and private, TradFi and DeFi, and so on. I think there are different roles to play. The role for the public agent is crucial, and he rightly emphasized this. What does it mean to provide a monetary anchor? To perform that critical political function, which is to stabilize the value of money. And what history teaches is that this is a political function, because it has to do with distributive justice.
And they are monopolists. They print the money.
But it's not just a matter of defending the status quo, a monopoly and a rent. It's a matter of providing a public good, let me put it this way. A reference unit for the relationship between debtors and creditors. And this is what the monetary policy is about. And this is what has to be left to the central bank and to its distinctive responsibilities. And then there's ample room for everyone else to...
Thank you. Thank you, Luca. Maybe I think I very much like to draw on the image that both yourself and Luca have mentioned about not throwing out the baby with the water, to make it like, in a way, pragmatic. I mean, in practice, I suspect that some of it has to do with what type of drawbacks that the system, the things that need to be improved in the system would be. But from a bank's point of view, from your point of view, what would be the first top priority, for example, in the risk space that we should avoid carrying over in the new world in order not to throw out the baby with the water in this new like stablecoin / central bank, new form of central bank money system?
Well, it's to bring together what has been said before. The key aspect, and I agree, is the necessity to have a sovereign payment system. And it looks to me like there is some confusion between sovereign and domestic. We used to have a lot of domestic payment systems, local, which have been progressively sold to Visa and MasterCard, and that's why if you go to the Nordic countries or to the Netherlands and so on, you need to have a Visa or a MasterCard in your pockets. So that proves that having a domestic system does not necessarily grant sovereignty. So if it's a political role to grant stability in the value of money and the distribution of money and so on, you also need a sovereign payment system. That is why it's not sufficient to talk about whether stable coins or crypto and so on can do a better job than the traditional financial system, banks and stock exchanges and so on. It's also, do we need also another angle that banks just cannot grant? It's not their job to grant sovereignty. They're not state functions. They're private companies that have to maximize profits and pay dividends and remunerate the capital that they're given. So that is where there is a bit of tension and where I think the monopolist has to step in and make sure that they grant what the banks cannot grant. It's not even clear to me that the banks should be in charge of the payment system. Visa and MasterCard are not banks, per se. So in Europe, you did used to have an anomaly in some markets, which was not granting economies of scale. So it was subscaled, it was suboptimal. Now we're having to find the new equilibrium. What is working? People still have trust in the banking system, and that is what to me has to be preserved, which is a very broad concept. It doesn't draw any sort of clear red lines, but the stability of the banking system is a positive byproduct of what we've got at the moment, of the regulation and intervention of central banks to prop it up at moments of crisis. I believe that there is room for all these new solutions, because technology is allowing better products, more needs, and more use cases. I'm very, very curious about the implementation of the digital euro app that you were talking about before, because to me that is the real key aspect of success or failure of the project. It's not sufficient to want to perpetuate an anchor. You have to be actually giving a good customer experience, be competitive, not just price-wise, but also in terms of friendliness and in flexibility. But what I think Nicolò has said before about programmability with usage of smart contracts and so on, it's really not clear from an outside standpoint that that system can actually be a platform where, in my view, then banks could compete for user applications, or if indeed it's not, it's a basic sort of a universal good at a very unrefined state, and then the more specific user applications have to go through a derivative of it, probably via stablecoins and so on. And to me, that will define the next ecosystem.
I want to stress the point. Test? Okay, thank you. Clearly working in crypto space doesn't give you technological skill, so I apologize in advance. But I think I want to draw one attention, which has been true throughout history, fundamentally. It's probably a path of least resistance, which takes the form nowadays into user experience, because users have been, used to pretty much very neat, sleek experience. First of all, Luca, would you agree? And then hand over to Giulio to what form does it take today?
Yes. You post two.
I agree.
You post 2 points. Sorry, you post 2 points. One is the adoption, because adoption is not magic. You can't say, okay, adoption is. You have a central bank, you have the adoption. Okay, you cannot impose this. Okay, so this is a point. The other point is the platform value of digital euro. I have a view for both the point, and it's very simple. The real path for the adoption is the benefit. So here, what are the benefits? The benefit for the political system, for the central bank, is the independence. We have already said that. Okay. The benefit for the merchant is probably in the price, because digital euro is a public infrastructure and it will compress the scheme fees. You know, in the compensation model of the payment system, you have the merchant fee, that is the sum of scheme fee, money that go to the scheme, and interchange fee. That is basically the fee that bank of the payer and bank of the payee exchange, okay, for the services. So the scheme fee will be compressed to zero. So there will be room to start with a lower merchant fee. So basically, especially if compared with the international payment schema that are quite more expensive than the domestic one, for the merchant will be less expensive. That is a very sensible political topic. And at the beginning, the price will be capped but from a European Central Bank. So the regulation is going toward this direction. The real challenge is which are the benefits for the consumers? Because in the payment systems, it's the consumer that choose the payment method, not the merchant. The merchant have to, and the banks have to adapt to the consumer needs. So I think that this is still partially an open challenge. What the ECB want to do is to provide the best possible user experience. That is something like, I mean, they took Apple Pay, Google Pay, the HC wallet, so NFC payment, very easy, very fast, and it's something that the other European wallet have not achieved yet, okay, because you have to tokenize a payment card to do it, and they request to us to develop this, and this is what we are doing. So our duty is to give to the consumer the best possible user experience. The real question is, which advantage will have the user to abandon Google Pay, Apple Pay, and their MasterCard and to use digital euro in the specific wallet? This is a question I have not the response now because it's a duty of ECB, and it's a duty even for the banking system. And for the second question, the platform. I think that we know that in Europe we have many domestic payments, account to account, card-based, very effective, but fragmented. So I think that for banks and for fintechs can be a real opportunity to scale their business all around Europe, because you will have a unique infrastructure, homogeneous all around Europe. And you touched the point of programmability. Digital euro cannot be programmable, absolutely, because it's central bank money. You can say euro have a value for you and have not a value for you, like in a smart contract. It's absolutely not possible because digital euro will have the legal tender. But it's possible to imagine all the use case of conditionality, event that trigger a payment, even that trigger some events, and all these, advanced use case will be left to the industry that is already working on it. So these are the points. In my opinion, the big challenge that is present in the digital euro now is how the European Central Bank and the European banks that will be involved will provide to the final consumer the benefit enough, to convince them to move from their actual payment system that are domestic. In Italy, domestic payment system is decreasing a lot. In Germany, for example, Girocard is still very strong. So we have to have, but there are many countries in Europe that have not a domestic payment system. Okay, so take this in mind. So the point is to, move the user from this American player, to the digital euro. This is the aim of the. Then our role is a provider. We are not a fan or a supporter of the digital euro. Okay, that's for. So I'm curious. I'm curious too to understand if they succeed. They will success in this. But that's the point. I don't know if is an answer to your question.
It is, but just to wrap up also the panel, maybe one last round, building on what you just said is, imagine like you're looking at before someone mentioned 2030, but let's go farther, let's say 2040. We looked at history, started from history, now let's look at the future to close up the panel. Maybe starting from Luca, how would you see that ecosystem where we have a merger that has happened? What would that look like? What are the key components? How do you see that going?
Let me say how I would like to see it, so without making forecasts, but
Goes without
wishful
saying.
thinking. Well, I see in the spirit of a complementarity, different functions performed by different monies. I see a role for a retail CBDC as a money anchor and exclusively as a means of exchange. Andrea was suggesting this before. There's no reason for it to become a store of value. There are other instruments and other players to fill in that function. I see a role for wholesale CBDCs also, because that's another issue. We have not touched upon that, but let me mention that. I see a role for private players for all the reasons that have been mentioned throughout. Let me just mention one last aspect. My biggest hope is that from all of this, what really emerges is a truly international currency. Because the biggest threat of this evolution, it was mentioned before, in stablecoins is not so much the technologies or the implication, but the fact that it embodies a new form of the monetary hegemony of the dollar that we have witnessed so far. And this is becoming increasingly dangerous for all of the actors involved. So what I see is an international currency, perhaps backed by commodities. I would like to see this aspect develop more. Stable coins pegged not to currencies or to other assets, but to commodities. The tokenization of commodities is one of the most promising trends that I see there.
Thank you. And just to conclude, Andrea, what's your view? And then we can thank all the speakers.
I think the asteroids will have landed by then. So by nature, then there will be fewer Bankosauruses. Technology is anyway a sort of natural selection for banks, and they're converging more and more to the sort of digital company form. So scale is important, cost structure is important. So I think that there will be a natural selection there. And I think that we'll have two fighting forces. On one hand, it is a sort of Darwinian selection which is not inevitable to me. It's got to do a lot with the reaction and sort of adaptation of the species. I have not seen much urgency in the banking system, especially in Europe in the last few years, to evolve. I think that the pressure is rising, and a few of the Bankosauruses are mutating, and that's very positive in my view. So one will be an evolutionary force of, if banks evolve, they'll manage to transform and therefore perpetuate in being a player. If other players, like it was said before, whether crypto exchanges can then start capturing other commodities, tokenized and so on, they'll challenge the current exchanges, and I think there will be an overall further expansion in the financial system. What is key, though, and I just connect to what has just been said, is geopolitics is going to play a big role. And we have been used to just thinking about a free global world with a free movement of capital as well. I'm starting to have my doubts that this is a permanent condition. And that certainly would be a very big cap to sort of global expansion, global development of the industry. If you start drawing borders, then it's a natural cap to development and to growth.
Thank you, Andrea. Maybe Giulio, just
but
for a
two
last
words,
take on this.
because I have not an answer, basically because I think that this is the era of uncertainty. And Italy is a very small piece of another small piece that is Europe. And what's happening now in the world that is changing every day, and we are in this sort of washing machine every morning, reading what happened last night can change the scenario. I think that we are living really in the uncertainty. So I am not able to, formulate any forecast for the future. So I think that I will close with this.
That's food for thoughts for everyone.
Really honest.
It's fair enough. I think that's what we want. But thank you anyway for sharing all your thoughts. Thank you for participating to the panel, and I'd like to ask the audience for one final round of applause for our speakers. And that concludes the panel. Thank you.
Thank you for all the panelists to join us today. Now we have a lunch break, and then for those who are interested, in the afternoon, 2:30, we'll have the last presentation from the Digital Gold Institute, which is one of the collaborator and creator of this Crypto Asset Lab, to produce and present their own quarterly report on digital assets. And if you, Ferdinando, want to say something, since you are one of the joint organizer of the conference, just few words, then we leave the floor later on to the Digital Gold Institute.
Well, thank you, everybody. As somebody has pointed out, this is being the 6th edition. It's quite an achievement. When we started, we were not even hoping for such a long stretch, and the conference is growing. And this, of course, is the merit not just of us in the program committee, but the whole team supporting us in the organization, and the Milano Bicocca being our guest, the European Commission helping us in the organization, and all of you, attendants, speakers, and participants. So thank you very much. The conference is not finished yet. This afternoon I will be presenting the quarterly report of the Digital Gold Institute, but for whoever might have to leave after lunch, see you next year.
So see you next year. And then follow our new website with news, and then what we are trying to do with other colleagues from Europe, maybe US, to create a network of crypto lovers, researcher, and then to meet more frequently. There's just once a year in a conference, but smaller workshops where we gather together and share our research and knowledge. Thank you all, and then see you next year.